Good afternoon. I'd like to welcome everyone today to our roundtable on income statement disaggregation, our proposed update. I'm Mary Mazzella. I'm an assistant director here at the FASB. I'd like to thank everyone in person here and on Zoom for your participation today. Many of you have contributed to the development of the proposed update, and we really appreciate the feedback you provided thus far in our initial deliberations, and we look forward to continuing the discussion today and your continued involvement in the project. First, we'll start with doing introductions. So I'm going to start with Gary and we'll go around the room and then we'll do Zoom.
Gary Sardo, FASB Practice Fellow.
Adam Thurman, FASB Practice Fellow.
Michael Lupo, FASB Project Manager.
Maddie Stolper, FASB PTA.
Josh Costo, FASB PTA.
Jeff Rickman, FASB Investor Liaison.
Julie Project Manager.
Good morning, Sue Cosper, FASB.
Matt Winters, CFA Institute.
Michael Taylor, Greif.
Joyce Joseph, FASB.
Good morning, Angela Newell, BDO.
Good morning, Disnada Mach, Meta.
Patty Castaneda, IBM.
Mark Mahar, EY.
Christine Bodison, FASB.
Hi there, I'm Dan Loveridge, Allstate.
Joe Holmes, Thermo Fisher Scientific.
Matt Janzarek, Procter & Gamble.
Rich Jones, FASB.
Angela Ferguson, PwC.
Holly Grennan, Nike.
Charlena Arsenault, Delta Technologies.
Marcia Hunt, FASB.
Mark Crowley, AICPA FinRec Chair.
Amanda Convery, American Accounting Association, FARS Committee.
Fred Cannon, FASB.
Kristen Bauer, Deloitte.
Scott Dolger, Bristol Myers Squibb.
Greg Ferris, ExxonMobil.
Michael Cleary, Boeing.
Jim Croker, FASB.
David Gonzalez, Moody's.
Hillary Salo, FASB Technical Director.
Nellie Debler, FASB Deputy Technical Director.
Okay, great. And then if we could go to Zoom, maybe we'll start with Nirav.
Sorry, I forgot to mute. Hi, this is Nirav Parikh. I work at Mutual of America Capital Management.
Okay, Brad.
Hi, Brad Rexroad at Say Research.
Jonathan.
Jonathan Wiggins from the SEC staff.
Sarah.
Sarah Madras with the PCAOB.
And Tim.
Tim Phelps, KPMG.
And then we also have Heather McPherson from T. Rowe Price is going to be joining on the Zoom a little bit later. So if you see her pop up. Okay, great. Just a couple of logistical things first, just for those of you that are new to the FASB roundtables, a couple of things. If you want to get on the discussion, just raise your name tent and Gary's going to help me keep track of the queue. On Zoom, if you could use the raise your hand function, that would be really helpful just so we can kind of keep track of who wants to get in on the discussion. On the microphones, you just hit the button, it'll turn green and you speak. Just a warning that the cameras are tied to the microphones. So once you hit your microphone, it'll zoom in on you. So just wait until you're ready to speak to get going. We don't have a break on the schedule, but we're going to try to squeeze a 5-minute break in somewhere. So when that happens, I'll let you know. In the meantime, feel free to get up if you need to leave. There's snacks and restroom out to the door here. And like I said, we'll have 5 minutes, probably about halfway through that we'll work in there as the discussion allows for. And lastly, some good news. We're going to provide CPE credits to those participating today. So a nice little holiday gift. So now that we've got all the formalities out of the way, we can get to the crux of our discussion. So just to start a little bit of the objective of the DISE project that we're going to talk about today is what we're trying to do is provide disaggregated information about a public business entity's expenses. And why are we doing this? We want to help investors to understand the entity's performance, to help them better assess prospects for future cash flows, and compare an entity's performance both over time and with that of other entities. The board had observed that there's detailed footnotes for lots of different balance sheet accounts, but if you want to get information about the income statement, it's kind of sprinkled throughout the footnotes today, and there's a lot of information that's not in there for things like SG&A and cost of goods sold, which is often some of the biggest expense captions on an entity's income statement. So at the end of July, we issued our exposure draft with a 90-day comment period. During that comment period, in addition to getting the letters, we did investor outreach. So we've talked to investors to hear their perspective on whether what we're proposing is decision useful and what their feedback is. And we've received about 80 comment letters to date on the proposal. We appreciate all the time that stakeholders have spent to provide us detailed feedback. I think we were really encouraged to see the constructive feedback and solutions that were in there. And I think a lot of that we're going to get to discuss today to think about what we propose and how we can help move it forward and make improvements to make it operable and decision useful. In the roundtable materials, we included some of the summaries, high level of the investor outreach, and some of the summaries of the high level comment letter themes to help us with our discussion. Today, you'll see from the agenda, we've identified a few key areas that we want to dig into. Certainly, we can't dig into every aspect of the proposal, but we hope to gain constructive feedback on those key aspects. And the team is continuing to review all of the comment letters, all of the suggestions, and we'll follow up with respondents and with investors as needed as we work our way through the feedback. The discussion today is going to be important input for the board. We've got the board members here, but as we start redeliberations early next year, this is another feedback data point in addition to the investor feedback and the comment letters, to provide the board with what stakeholders think about what we've proposed. So as I've mentioned, we received 80 comment letters about what worked and what has room for improvement. We're focusing, we're going to start with the overall approach, then dig into the relevant expense captions, spend a good chunk of time on inventory, and then wrap up with the qualitative assessment, some of the other lists of disclosures we've got, selling expenses and scope. So really the bulk of our time we think will be spent on topics 1 and 2, as those are the meatiest aspects of the proposal. So with that, I'm going to turn over to Gary, who's going to kick us off on topic 1.
Okay, thanks, Mary. So topic 1 is broken out into 2 subtopics. The first, topic 1A, is on the overall approach of identifying relevant expense captions for disaggregation. And the second, topic 1B, is on the disaggregation of certain required expense categories within those relevant expense captions. We'll start off with topic 1A, pause for questions and discussion before moving on to topic 1B. So starting with 1A, the board decided that a relevant expense caption is any expense caption that is presented on the face of the income statement within continuing operations and contains at least one of the required expense categories that we'll cover in topic 1B. Investors generally express broad support for the proposed requirement to identify relevant expense captions because focusing on the substance of the expenses included in a caption likely would result in the disaggregation of expense captions that would be most meaningful for investors. Additionally, some investors suggested that the disaggregation of certain functional expenses, such as selling or R&D, should be required regardless of whether those expenses are presented separately on the face of the income statement. Most comment letter respondents that provided feedback on this topic stated that the identification of relevant expense captions is operable because the guidance is clear and flexible. With that said, some respondents expressed the following concerns. First, identifying relevant expense captions could impose significant costs on preparers. Some of those respondents suggested providing relief, such as exemptions for impracticability or practical expedients that would allow qualitative disclosure when substantially all of a relevant expense caption consists of one required expense category. Next, entities in certain industries that currently present additional natural expense disaggregation on the face of the income statements suggested that certain expense captions be excluded from the proposed requirements. Some of those respondents suggested clarifying how to identify relevant expense captions when income statements are presented using either only natural expense classification or a mix of both functional and natural expense classification. And lastly, several respondents requested clarification on how entities should consider materiality when applying the proposed amendments. I'll also add that prior to reaching its decision on identifying relevant expense captions for disaggregation, the board considered but dismissed several other approaches during the course of this project. First was a full disaggregation of functional expense captions such as cost of sales and SG&A into their natural components. Second was a disaggregation approach that would have leveraged how consolidated expenses are viewed internally by management, which is somewhat similar in concept to the management approach used in segment reporting. Third is a disaggregation principle for cost of sales and SG&A that would have been similar to the existing disaggregation requirement for revenue from contracts with customers. Reasons for the board's conclusions on these other approaches, which includes consideration of feedback received from preparers, investors, and other stakeholders, is described in the basis for conclusions of the proposed update. With that, we can get started and open the discussion on questions 1 through 3 in the handout, again, related to the proposed guidance for identifying relevant expense captions and the application of materiality guidance.
So just if whoever wants to go first, if you want to raise your hand. And again, I think, we're starting off with the overall approach, kind of, did we hit the mark? I think, as Gary summed up, like we're on a disclosure approach. We're not changing income statement presentation. You're using what you've got in your income statement as a starting point and kind of drilling in is the theory. So I think we wanted to start with that. In the mixed presentation, we also got a lot of comments on in the exposure draft. So just want to see if there's comments on that. Matt?
Yeah, so no disagreements with like the principle of disaggregation. I think it's pretty intuitive that disaggregating a quantity that is highly aggregated and contains things with heterogeneous items with multiple drivers would improve investors' ability to evaluate that item, forecast it, compare it to other entities. So I think sort of a comment and a little bit of a question is, at least the feedback that we always receive from investors is that investors typically evaluate, model, and value companies on a segment approach, using segments for companies that of course have multiple reporting segments. But I think this proposal is pretty much completely isolated from the segment footnote. It's a completely different basis of disaggregation. And so really, I guess sort of my question is, did the board consider, rather than having the income statement captions be what is identified and then disaggregated, for it to be segment expenses to be identified and then disaggregated?
Maybe just stepping back a little bit of background that might help frame up our discussion is we've kind of got a whole suite of, I would say, investor-focused projects that we've been working on recently, especially since we had our last agenda consultation in 2021. So I think when you look at them in conjunction, we can't just look at DISE necessarily. So here we've got the consolidated income statement, and we want to drill in and get some more detail. We've got our segments project, which we just issued our final standard a couple of weeks ago. That's going to provide more information by segment based on the CODM lens. And then also we just added a cash flow project. So we're looking at that separately. So I think the way we've been thinking about it is like, as a whole, these are getting investors more information on where they might want to dig into. So like the segments will have more information about expenses, but you kind of have to look at them holistically to see all the pieces to see what we're providing.
If I could just respond to, like, I think just my concern is that the segment footnote will be not reconciled. Like those significant segment expenses won't be reconciled to the nearest captions on the income statement. And so this is another disaggregation footnote, but it won't be reconciled with the segment footnote. So investors will kind of have these 3 different sources, right? Maybe 4 if you include non-GAAP, that aren't really reconciled. So I think what would be, so it's more just a comment, is that we're going to have these different sources of disaggregated information that aren't reconciled.
Okay, thank you. David?
I mean, I think I've spoken about this a few times, but I think this is a nice step towards where we would like to be in a disaggregated environment. I would consider it a step, and I consider it, I think I've said very many times, like a bare minimum of a disaggregation project on a full consolidated level that has the drivers of financial statement line items that are already separated. And if they are separated, it should be important enough for us to be able to understand what the drivers of each one of these line items is. And I think that goes there. We have similar discussions about the segments, but it's like just staying in the scope here, we think we can get it to the drivers from the income statement to get there. But there are things that we would like, and subcategories or different areas, but we understand the kind of trouble that we've already gotten in to get here. But we appreciate that these inputs would be a nice start and a nice look at financial statement information in kind of a little bit of a different way with consistent disaggregated information. And I was here it feels like yesterday, but on the revenue roundtable. And I think a lot of the positive feedback was very similar to the goal of this project was consistency of the revenue numbers, consistency of the presentation, comparability across, not having to go forward. And I just kept writing those down as it was coming through because I think it's a very valuable way to look at financial statements is to have consistent disaggregated financial statement information.
Michael?
I guess just an observation or question or comment. So understand a couple of folks have just discussed sort of an investor request for additional information. It's not consistent with what we see from the investors and analysts that cover our company. They don't tend to ask for this level of information. And I think in the comments here, it mentioned that as well, that others said the same thing. So there seems to be a bit of disconnect here. We're being asked to do something. It's difficult to see the value, and we're not being asked in general to provide that level of information.
I don't know if any of our, maybe I'll call on Rich next, but if any of our investors online want to get in on the discussion after that as well. Rich?
Yeah, I was just going to mention because that's a common refrain we hear from preparers. And when we did our investor outreach, what we were told was we don't commonly ask for information that we know the company can't give us. And so I guess my request would be, to the extent that any of you are dealing with your investor relations group and your investors, if you're actually in touch with investors who say, yes, we don't want this information, there's something else we'd want, please put us in touch with them, because it would be very helpful for us to hear it from them. The other thing I would kind of refrain, one of the challenges with this project is we immediately get into a discussion of disaggregation and more information. And I think it's always helpful to step back. And really one of the fundamental focuses of this project is, if we pick up your income statement today and we look at an income statement line item, can we go to a footnote and understand what's in it? And if the answer to that is no, I think that's the fundamental thing we're hearing from investors is they can't do that. They have lots of requests, recurring, non-recurring, cash, non-cash, fixed, variable, right? Which are all kind of defined in the eye of the beholder. So we've kind of come around with, hey, here's certain key items, and they help investors with that analysis. So that's kind of been our focus. But I would say if you're hearing different things from your investors, meaning they don't find this helpful, it would be very helpful for us to hear it from them.
Nira?
Thank you. So just in response to that last comment, I mean, as an investor, I would say it would be quite helpful to actually have a little more detailed information, and possibly investors are not asking you for it because they don't know it's available or even possible. I think if you were to present them with this, a good portion, definitely majority, I believe, would definitely take it and, receive it and actually be able to ask more detailed questions. I think where the project stands now, I concur with David, it's a very good first step. There could be some changes or additions to it. However, I do think it's a very good first step. And once you start providing it, I think it'll lead to richer discussions with management and investors. And I hear sort of the comments, and I've read about them, about the cost and the time that it would take to prepare it. I definitely appreciate that. However, I guess I wonder why that's not sort of done internally already. I think it could even possibly lead to richer internal discussions if some of this was provided. And then lastly, I mean, if appropriate now, I think one addition would be to actually separate selling and kind of get disaggregated as well. But I mean, I can sort of discuss that later, but I'll stop there.
Fred, did you want to jump in?
Oh, I was just going to underscore what's been said. I think the important point, factual point, is that where this information is available, users use it extensively. If we look at the bank income statements where it is disaggregated, as I was a bank analyst, every bank analyst puts that into their model and models it extensively. So we know that when it is available, it is used. So just as a background.
Brad? You're on mute.
Sorry. I was saying, I just want to add on what Narav said. I think the reason you're not getting these questions is because it'd be a violation of Reg FD for you to provide that information if it was not disclosed within the SEC filings. And so as an investor, I can ask the question, but I know the answer is going to be no, we're not going to tell you because we would have to provide that in public forum. So I think that's the reason why you're not getting these questions asked. And I think as an investor, for me, in addition to what Narav mentioned, this is going to be tremendously helpful for not only understanding the different portions of what's going in the expense items, but also in modeling things out in terms of what are variable costs, what are fixed costs, incremental margins, things like that. It's a game changer when it comes to modeling a company out going forward. So I wholly support the proposal, and I will pass the baton.
Patty?
Thanks. So I appreciate all the investor input that's been said so far. I guess I would just add from a preparer perspective, we have worked extensively with our IR team to try to understand what it is our investors are asking for. And really from our perspective, they are asking for this information or information in general on the segments or on a total company basis. So perhaps it's unique to us, but our segments really align with our underlying businesses. And we have 4 distinct underlying businesses: software, consulting, infrastructure, and financing. And so we have analysts that follow us from different industries specific to hear how our specific underlying businesses are. So we have software analysts who follow us for software performance and then compare that to our peers. So at least specific to us, we feel like looking at this more from a segment perspective or a total perspective would be more beneficial. And we also feel that if we were to provide this at the disaggregation level that's being proposed, that our investors would likely just aggregate that information up to look at a total company view.
Okay, we're going to keep going around the queue, but I know we've spent a lot of time on this first question. I think we've got through the comment letters and through the feedback, kind of the message of where we've got kind of divisive views. And I don't know that we're expecting to reconcile all those today. We'll continue with the queue of people that have their tents up. I'd like to also make sure we don't lose sight of the second and third questions. So I think we can still talk about approaches as we go around with who's already got their tents up. But just if there's anything additional in terms of those that have a mixed presentation or natural expenses or the topic of materiality, I think those were things that kind of came through in the letters that we're looking at hard as a team. If there's anything that we need to clarify, I just want to make sure we have a chance to get to those points too. So I think Daniel is next in the queue.
Yep, I'll touch on 2 topics, I guess. One is just from an insurance industry specific perspective. We went through many years ago in 2015, went through additional disclosures for our short duration contracts in the property and casualty insurance industry. And so that set a level of information that investors at that time ultimately wanted in terms of allocated and unallocated claim expenses. And then we just wrapped up a project that I was involved in 2023 with the implementation of long duration, where we added extra disclosures there on different items and drilled down, for example, into deferred policy acquisition costs to be able to give kind of that roll forward and that view in terms of here are the adds and here's the amortization. So in terms of that, and then in general, if you look at kind of 10Ks today and kind of what, in terms of what we're presenting to investors, a lot of it's focused on expense ratio, like total expenses. What does it take to ultimately settle a claim overall? And so there is that kind of that view. If you look at a lot of the top 10Ks of the top property and casualty insurance for those companies, ultimately, it's an all-in expense ratio view is kind of how they're looking at it. So there are some views there, and that's some background as to why we ask for that exemption in terms of the insurance specific claim and claim expense line items, to be able to not have to provide detail there, but would look to add more detail in the other line items. I can add in terms of materiality if that's helpful. I think in general, what would be helpful is at least some level of guidance in terms of what's material. I know internally, as I talked to some of my colleagues, as we went through this process, we went through different examples of what is or what should be disclosed in certain circumstances. So if you have a very large majority of one of the required expense categories in a single line item, is it necessary to disclose then something that's immaterial that's sitting in that second line item? And so just having some guidance in terms of how to think about various scenarios, not bright line thresholds, but how to think through certain things to be able to apply the ASC 105 guidance would be helpful and allow for comparability and consistency across preparers.
Thank you. Amanda?
Yes, to speak to our overall view from an academic perspective, we have a long line of research that looks at disaggregation of income statement items with publicly traded information or publicly available information, and it finds those to be useful for improving predictive value of our models. But interestingly, there's also experimental evidence where we can create, as if scenarios, and that evidence finds not only increased predictive value, but also increased reliability of earnings forecasts and other measures of decision usefulness from the participants in those experiments. So overall, I think that we would support additional disaggregation. So thanks.
Holly?
Focusing on the materiality question, just as a little bit of background, Nike has a small manufacturing arm that produces product that is ultimately ends up in our product that we buy from a third party. So we don't really recognize any revenue related to that manufactured product in-house. And that being said, it doesn't really have a material impact on our business. So the total amount might be material in regards to our gross materiality, but getting some additional guidance on what is material or when you would have to do some of these disclosures would be incredibly helpful, because I think there could arise a difference in opinion on what is material and what isn't between our auditors and ourselves. I know what I think it would be, but that would be very helpful. And I don't think doing the breakout for that piece of the business would be provide any decision useful information.
Michael Cleary?
So I just want to provide a perspective from we're a large aerospace and defense contractor, and also a very large manufacturing company. And we disclose in our 10K that we have a long operating cycle that goes well beyond a year. Most of our contracts with customers tend to be span many years. When I talk about large operating cycle, and some of the comments from the analysts really resonate. So if you look at some of our numbers, our cost of sales is around north of 60 billion. Inventory is close to 80 billion. Advances close to 50 billion, over 50 billion. So just as a sense of like a regulated company, and what does highly regulated company mean? The fact that we are, and the other aerospace and defense companies have to comply with US government accounting requirements, which means that every labor dollar we incur has to get allocated to a contract line item. And we have to take all our costs from corporate all the way down to the factory and charge them to the very specific contracts that we're working on. So whether you approach it from picking up the inventory and trying to say, well, what costs are in this? Or you approach it from the perspective of, well, I incurred this labor cost, where did it go? Once we push it into this big allocation, and then it gets reallocated and reallocated and reallocated, it loses its visibility. And so for us, it's pretty much impossible to come up with what these natural expense categories are. So we would say that this, the proposal to try to disaggregate this by natural expense, especially when we talk about the items that get recognized in the income statement versus the items that get incurred in the period, there's just massive sort of disconnect. But we can never really go back and break that down at this very specific level that's contemplated. All of our systems are configured to track and allocate costs to contracts. And then I would say, we have multiple ERP systems. Most of the A&D companies in this country sort of all are the results of lots of mergers and acquisitions. We have multiple systems. We would think that the providers would need to spend a fair amount of time trying to figure out how to adapt their systems to very complicated industries. And, we were also one of the industries that had a very heavy lift with 606, but our assessment is this is way more complex and will be way more difficult to implement than 606. And then maybe finally, just a comment on decision usefulness. Some of the comments were well made about what do we use to manage our business? Well, this is not how we manage our business. We don't track these costs internally in that regard. What drives what we spend is the mix of products that we're making, the contracts we have. That's what drives us. And then in terms of maybe analyst predictability, well, because you have long-term contracts, a lot of times you have things like escalation clauses. Some of the government contracts are very cost type contracts, which means that whatever costs we incur, we pass on to a customer. So I think that for the analyst predictability, I think that would be probably require a lot more perspective. And we work very closely with our analysts. And our analysts tend to, if you go back to my opening comment about our numbers, our analysts tend to be very focused on orders. They're very focused on our production rates. They're very focused on our deliveries. And they're very focused on the margins we're realizing across our different segments. So that's just a perspective from somebody who would be very severely impacted by this. And we have an industry group. And a few of the industry groups have submitted letters. And so I think this is the pain that's being felt across our industry sector. Thank you.
Thanks. So we'll do Michael and then Matt, and then I think we're going to move on to 1B.
Thanks. Yeah, just echo that and some of the investor comments as well. We have the segment disclosures coming out, which are more consistent with how we're managing internally, and we think are going to provide investors sort of the type of information on a cost basis that would be helpful to them. And then just on materiality, I guess I'd offer the opposing view from what others had shared, is that being able to apply materiality the way we generally think about materiality, I believe would just make this easier. Adding more requirements or more ways to think about it, I think is just going to make it more complicated and take some of our ability to navigate the requirements based on our circumstances. Thanks.
Yeah, just on materiality, I think two comments. One on materiality is that I think a concern that that we have is that if let's say there's a required expense category it's only 5% of this caption, 4% of this caption, 3% of this caption, 5% of this one, and none of that's material. Okay, then it's all gone, right? So I'm worried that if there is a materiality floor set for disaggregation, that could potentially encourage the sort of classification or distribution of some of these expense categories in order to such that they then escape disaggregation. So I think that if an item or if an expense category itself is material, then its disaggregation ought to be required. But of course, if that category has for some reason, right, if employee compensation is only 1% of total OpEx, then fair enough. That'd be a different story. And just just wanted to respond on the management approach versus sort of a prescriptive approach with disaggregation. You're definitely sympathetic to this, that perhaps the way that management looks at its own business is different than the way that or is unique, and it's different than, so that maybe it's different than the way that a manager of a different business, even in the same industry, looks at that. So however, I think what's important for investors or just the investor perspective is that many investors, particularly on the buy side, are looking at many companies, not just in a single industry. So I think this would be akin to, right, if you were, I don't know, if you owned 100 restaurants, perhaps 100 different restaurant managers would say, oh, well, I manage my business differently, so I'm going to provide you financial reports in the way that I want to. Well, that would then be very challenging then to compare your different, your different restaurants, your different business units. So that's why I think comparability for investors comparability is so important, because you're generally in the setting of a diversified portfolio. You're have an investment strategy. You're comparing a bunch of different companies within an industry, and also just within a sector as a whole. So that's why we tend to favor a prescriptive approach rather than a management approach.
Thanks. And I'm going to turn over to Gary. He's going to tee up 1B.
Okay, thanks, Mary. So moving to 1B, the DISE proposal would require that all relevant expense captions that we've just chatted through would be disaggregated into the following required expense categories: inventory and manufacturing expense, employee compensation, depreciation, intangible asset amortization, and depreciation, depletion, and amortization recognized as part of oil and gas producing activities, which, to save time, we'll refer to as DD&A throughout the session today. This session relates to employee comp, depreciation, intangible asset amortization, and DD&A. Inventory and manufacturing expense will be addressed in the next session, so please, to the extent you can, hold discussion on that until we move to topic 2A. So the proposed amendments also include a new definition of employee compensation, which includes specific types of cash and non-cash compensation that are required to be included in the expense amount, and also an option for an entity to include other types of compensation in that expense amount. The proposal also includes an amended definition of employee, which generally leverages the existing definition in topic 718. Given feedback received from some comment letter respondents, I thought it'd be worth clarifying that the proposed amendments would not require disclosure of compensation paid to non-employee service providers. Additionally, the proposed amendments would not require disaggregation of the following amounts into the required expense categories. First, entities would not need to disaggregate the subsequent measurement of assets. For example, entities would not need to disaggregate the amortization of internally developed software and the depreciation of internally constructed PP&E into employee compensation and other types of natural expenses. The amounts presented in the proposed disclosures for these items would just be amortization and depreciation, respectively. Second, entities would not need to disaggregate warranty expense, insurance claims expense, and similar accruals into employee compensation and other types of natural expenses. Almost all investors broadly supported the required expense categories because, as Mary said earlier, they would provide relevant, reliable, and comparable information that would allow them to better assess an entity's performance and future cash flows. Some investors stated that the proposal is a good first step, but asked for more. Some of these suggestions include the following. First, additional required expense categories such as utilities and energy, professional services fees, among others. Second, the expansion of required expense categories to include other similar costs or a further disaggregation of an expense category into its components. For example, some investors suggested expanding employee compensation to include other similar costs of an entity's workforce, further disaggregating employee compensation into different types of cash and non-cash compensation, and further disaggregating intangible asset amortization into amortization of acquired intangible assets and amortization of internally developed intangible assets. Third, disclosing total amounts for the required expense categories, some of whom also suggested that those totals be presented on a cost incurred basis. And last, combining depreciation, intangible asset amortization, and DD&A into one category, or removing them from the list of required categories. Nearly all preparers and other comment letter respondents expressed concerns about operability and costs, some of which were relayed in the previous session. Specifically, most of those respondents raised concerns around current system limitations, the need to design processes and controls to compile and report the expense information, and the lack of human resources to implement the proposed requirements. In addition to that general feedback, many preparers and other respondents raised concerns about the effects of cost center allocations and intercompany transactions, the effects of foreign currency transactions, entities with decentralized finance functions and multiple ERP systems, their systems and processes being configured to how management analyzes the business, which we touched on, isolating employee compensation from other workforce costs, the effect of proportionate consolidation and joint venture arrangements, and that the disclosure of information may cause competitive harm. Additionally, respondents questioned whether the information would be decision useful for investors. Again, some of which we covered in the previous session, that the information is not typically requested by investors and analysts, that the categories are not consistent with internal management of how costs are managed and performance is assessed. The amounts for employee compensation may not be complete or comparable. The required categories don't adequately describe the major factors that impact performance, and existing income statement presentation guidance results in diversity in the presentation of income statement captions and the classification of expenses within those captions. Accordingly, some comment letter respondents provided suggestions for improvements, such as disclosing required expense categories in total rather than for each relevant expense caption, disclosing amounts on a cost incurred basis, and replacing DD&A with depletion and expanding the scope of that beyond just oil and gas entities. With that, we can open up the discussion on questions 4 through 8 in the handout related to decision usefulness and operability of the required expense categories, and whether there's any challenges from an audit perspective with respect to those categories.
Yeah, maybe to help guide our discussion a little bit, I think out of the required list, unless anyone disagrees, I think employee comp is probably the one we heard loudest from investors, that they're looking more information on labor costs or employee costs. What we've included in the materials is, obviously you saw what we defined in the ED, and we've had some suggestions about how to make that operable. So maybe if we could just open it up, focusing on employee comp in these questions, and then we can hit on the other items as we move through the discussion. Michael?
Yeah, on question 8, we would be in favor of an accounting policy on employee compensation. It's recorded in a lot of different places for a lot of different reasons. And there are also costs related to our production that may not necessarily fall into employee compensation's definition. So I think it would give a more meaningful answer if we could define that sort of as our labor costs.
Thank you. I think on the employee comp, maybe just a little more background too, is I think when we were going through deliberations, we kind of struggled with this a bit of, do we define it? Do we not? Do you get better comparability if you define it versus letting companies define? I think we heard loud and clear a lot of comments on non-employee labor. So how do you compare a company that uses entirely contract labor to not? So I think, I see some tense up, but any feedback on just kind of like the direction to go on those is really helpful. So Jim?
Mary, I was going to make similar point. I think we were trying to be helpful in defining employee comp so that people knew where to begin and end. And so we didn't get into debates about what services that are provided to me by people who are not my employees would need to go in that line item. Is it my external counsel? I could hire in-house counsel. And virtually every service that you receive, and in fact, every manufactured item that you purchase, you could choose to do in-house. So I have contract manufacturing. Should I do, the depreciation of the contract manufacturer and pull it into mine, or the labor or otherwise? I think it was an effort to try and be helpful, but I certainly would be open, maybe others are as well, to saying this is the minimum for what you need to include as comp. But if you want to then add that which you believe is the functional equivalent of labor that's from external parties, describe your policy and include that either separately or in a combined number. But I think struggling a little bit with the feedback that says, well, don't do this because, and I'm not saying you said that, but we certainly heard, well, this doesn't include everything that I could have done in-house. We could do that. I suspect that the pushback we would get is no one would know where to begin and end with respect to third-party services. So maybe with that as a little bit of a lens, if we were to do something different, could you actually operationalize it?
Yeah, and I think we treaded into that a little bit in the definition we have, because I think one of the things that we heard through our outreach were examples like, well, if I have a car that my employee is using, like, is that part of the comp definition? And is there food expense? So we try to include a little bit of flexibility in the definition, but to the extent we hear examples that are helpful to clarify, or how far that floor is, or how much specificity, that's really helpful, because we want to try to come up with something that's going to be operable and also useful. So David?
Yeah, and I mean, there are different types of investors out there, and this is this project to me is about comparability. And I think that the definition should be there. And if you add anything to it, it needs to be separately disaggregated because there are issues with employee compensation. I think everybody knows here, this is not a complete picture of employee compensation depending on capitalization and things like that. So there is a little bit from our side that we're dealing with a completeness test. And so I can ask this company what their employee comp is, and I can say, why is it so low here? I can assume it's because of external things, but I want to be able to keep that population stable across the way because I think everybody that is on the investor side wants more. We want the contract. We want all the other stuff. We want this disaggregated to understand all of the decision types of employee compensation, but we're getting employee compensation. And if we're getting it, it's much easier to understand it and understand the holes in it if we have a very consistent part of it. And I'm happy if you want to add something else, but make sure it's disaggregated and clear what that something else is. Don't lump it into what this definition is if we're not going to be a complete picture.
Scott?
Yeah, specific to the question 8.2, I think allowing companies flexibility, like providing like a minimal, like here's examples of what is included in employee compensation. But I think one of the important things here is like companies, industries are different. And so allowing that flexibility of like, well, what's important for our company? How do we look at things too? And, we can define that and disclose some of that information too, but providing that flexibility there. What I worry about is if it gets too prescriptive, then is it going to be difficult for all companies to apply with that too?
Patty?
Yeah, so I guess when we thought about this just from a general perspective, we would have preferred to have a definition that's already grounded in GAAP as employee is, just given the knock-on effect to other disclosures we have that already are dependent upon that current definition. So just from that kind of high level perspective, we would prefer that approach, but perhaps maybe some implementation guidance on how we should think about this or approach it would be helpful.
Matt?
Yeah, just two things. We first just want to echo what David said is that we would definitely appreciate augmenting the disclosure with with labor costs from people who provide similar services to employees. Like there's a similar definition under IFRS for that, but we wouldn't want to augment this by just simply making this definition bigger, because that would just create another aggregated category. So if it is going to be augmented, we would definitely really strongly prefer just adding another definition and adding a separate category such that it's not obfuscated. The second point, a little bit of a technical one, but on the definition of employee, no really huge issues, but there may be some kind of unintended consequences of tying the financial reporting definition of employee to a legal definition of employee. In that laws can change, different laws are in different places. So in financial reporting and laws, I think have different objectives. So I think that it would be a challenge, but I think that we would have a kind of modest preference for a financial reporting definition of employee rather than purely relying on a legal one.
And one of the things that Gary had mentioned that we heard a lot of feedback on was totals. So whether it be related to employee comp or other definitions, just thoughts on that. I think as we talked about in the approach, we took the approach of drilling into individual income statement line items, and the board had discussed requiring totals specifically in the context of employee compensation. I think there were some concerns about operability and just kind of that total not tying back to anything, because some of those costs are capitalized. I think we heard kind of competing suggestions on totals. I think we heard maybe from some of the investors, it'd be nice to have all of the detail plus the totals. I think in some of the comment letters we heard, maybe in lieu of the details, we could do totals. So just if there's any thoughts on totals for employee comp or for any of the other captions, just any feedback that anyone would like to share on that topic. David?
I like totals on top of this disaggregation, but totals alone don't really do. I mean, yes, totals alone are better than what I have today, but then just give me net income and don't disaggregate your revenue and all of your costs. These things are separated because they're important. So I want the drivers of what is important as best I can. And for things like employee compensation, I actually think a total would be really helpful. I know what I'm going to be told is that I won't understand the accrual accounting or way things are capitalized, but I think the delta there in between the disaggregated portion and the total will cause investors to have to learn what the difference is and have to learn what they're missing there. And it isn't intuitive. And I give that. There's a lot of education that needs to go into understanding how this disaggregation project works. But I also think a total would point out the need for that education.
I think, is Christine, is your tent up? It's hard to see. Thanks.
Yeah, I just have a question to follow up with David on that last point. So without the total for employee comp, what level of concern do you have that there may be users that will misunderstand the disaggregation information and think that it is the total when it's not?
Personally, it's pretty low because I mean, I know there's things out there like competitive harm and things. We're at 20,000 feet here. We're getting directional information into where expenses are going. I don't think it's precise enough to cause a problem. Some of these differences between incurred and actually ran through. And the places where I think it's not off, I guess it'd be backwards, is the incurred model, which would drive more of the current expense environment. So if they didn't understand that, that wouldn't be as big a problem to me. I don't think the problems are hurtful. I think that they go towards an era of where the company is going faster versus something that could have been incurred 6, 7, 30 years ago for those differences. But it is nice to have that gap. And I think there will be some industries that are probably a lot more prominent in the gap between the total here that has nothing to do with the incurred or expensed model. It's just the gap into the capitalization of computer software, or I think insurance is heavily affected by this, though I don't know anything about insurance, so don't quote me on that part.
So just to make sure I understand, so what you're saying is you're not concerned that if the amount that's disaggregated is 70 and the total for the entity is 100 and that 100 is not disclosed anywhere, all an investor sees is the 70 based on the disaggregation, you're not concerned that they might look at that and think the total is 70, that they will understand that there could be comp sitting elsewhere in software, digital media, wherever, cost to acquire a contract and so forth.
Yeah, but I mean, on some level I am, but it's about what it's used for, right? And the 70 is going to be used for whatever's next period, or a directional, or taking the percent increase over time for a directional increase. We're still maybe, if we get through this, 5 categories into things we can apply different levers to and projections. So this is a proxy for taking an overall direction of an entity and kind of seeing what it would look like, or challenging management's assertion as we trended over time. And I think that we have enough pieces of the puzzle to challenge the overall assertion, even though we're missing in that 30 million of compensation, but we have the direction that the 70, because nobody's asking me what total comp is, and it's a quiz. We're just trying to go and use the information trending over time. And once the information trends over time, we will be able to ask better, smart questions about this stuff. And I think from like an analyst point of view, it's more directional and understanding versus getting every dollar. I want every dollar of the compensation, I do. And I think it's important to understand the total versus what we have. But I don't think it's like the biggest deal breaker out there or anything like that. I definitely support if we had a total there. I'd be concerned if the 70 we had was misleading on, and I think that in most all of the situations, the 70 will be enough and so much more than we have right now, and having these different levers, I can't like say how happy people are about it, or that they don't believe we're going to get it, or that are we going to have different metrics or do things with this? And all of these questions are circling.
Greg?
Yeah, David. So that's very good feedback to have, I guess, from the investor perspective. And I'd like to ask Brad and other investors to chime in. But for an industry like ours that's very capital intensive, how do you all control for that versus another entity where maybe the labor costs are more periodic or episodic as they run through the income statement? And I ask that because we expressed concern in our letter to the FASB about the challenges of certainly system limitations, but cost allocations, and trying to gather that data, knowing full well that a significant element of our labor costs do end up on the balance sheet. And how will this information be decision useful to the investors? And I think that's really kind of the key pieces of information we're trying to understand through this dialogue here.
I mean, I understand that it all comes on your balance sheet, and then your balance sheet comes out to the income statement. And so the drivers there, I just want to understand what those drivers are as best I can. And if your largest thing would be cost of goods sold and running through that, what drives your cost of goods sold? And I have to imagine we have the 4 top drivers of that. And so if I have to understand that on a cost incurred versus running through, I actually prefer kind of the cost incurred because of the directional nature of it, of where we are right now. But I would think that, I mean, it doesn't, if it's on your balance sheet, all of this stuff is very important. I want to understand, I mean, there's 8 line items on an income statement for a reason. And we just want to understand 4 of the biggest drivers of the thousands that are out there on this, so that we can kind of understand what direction this is going in. And I mean, I've talked about this a lot, but I just fully don't reconcile with the idea that this isn't decision useful. Like I can't get my head around that world that exists. I understand it's not asked about. I understand all these other questions, but everybody in here is vested in some way in financial reporting. How do we not all agree that this is decision useful? Like, that's the hardest part for me to get around.
Nirav?
Right. So to add to what David's saying for Greg's question, it can be useful even in a more capital intensive industry because as we've talked about earlier, comparability. So if we understand one capital intensive industry for one company, you could have maybe higher operating leverage as a result of lower people costs, relating that to sort of volume you produce. It does provide, some learning, some information, and for sure help on sort of forward modeling. So, I guess I'm reiterating part of what David said, but hopefully that helps.
Patty and Michael, I wasn't sure if your tents were up from the prior discussion or if you were trying to get in now. Okay, so I'll do Patty and then Michael.
Okay, thank you. So we, in our comment letter, proposed looking at the required expense captions from a total company perspective, really due to operability concerns that we have. So no matter which way you kind of slice or dice this, whether you're looking at it from disaggregating one relevant expense caption to all of them, or from a segment view, or even from the further disaggregation of inventory, which I know we'll get into later, we simply can't, our systems simply aren't set up right now to pull the expenses by nature. They are set up for SX reporting by functional line item. And like many other companies in the room, we use a significant amount of cost centers to manage our costs and expenses. And at the end of each month, those cost centers have to close out to 0. And the activity in those cost centers are moved into the functional line items by various ways. So one way is by transfer entries, which simply removes the nature of the expense and puts it into a functional expense line. And that transfer account will tell you what kind of cost center it came from. Another way we move data is via allocations, which are based on predetermined logic already set up. And then we also have the use of rates within our consolidation system. For example, with consulting, right, we have consultants who are going to charge their time, and those rates are fully burdened, and they're going to charge to a cost center and move it to the functional expense line. So all of these movements that are happening are done at an aggregate level, and the end result is once we're in our consolidated system, right, we cannot trace back to the nature of those expenses. So in order to really comply with the proposal as is, we would have to go through a significant system redesign, which would be very costly. It would take a lot of time. It would take a lot of resources. And I know there's other companies in the room also, well, maybe not in the room, but that we've talked to who are going through ERP transformations currently as well. So that's just going to compound the cost that it's going to take to comply with the requirement. So as written now, we would think we would need at least a minimum of 3 years if we were going to disaggregate by the relevant expense captions. So from an overall perspective, we are more supportive of disaggregating at the total company level.
Michael?
Yeah, so, I mean, similar comments to Patty. We don't think our systems are set up to do either right now. I guess so. One or the other. Just back to the original question. One or the other would be our preference. I would think, although this would need some studying on our part, that the current proposal would probably be easier for us than a totals, because the totals, it seems that just brings the entire income statement into scope. And my understanding is part of the purpose was to sort of narrow in on certain particular areas. So that's it.
Right, so we're going to do Scott, Holly, and Matt, and I think we've covered employee comp and total. So just while they're responding, if there's anything else on the other questions or relevant expense captions, we'll take those questions next before we move on to inventory. So yeah, Scott, Holly, and then Matt.
Yeah, so I'm actually not going to deal with employee comp, so I'll deal with question 4. So move us along there. I think one of the things, and I think you hear some of these comments too, is specifically when I think about question 4 and the categories that we're breaking down. I think one of the items is like internally, these categories that we have broken down is not how we look at our business, is the first thing. Second, what I worry about is we have it seems very prescriptive or rules-based, right? It's saying like, look, these are the categories that you should break down and disaggregate and talk about from a company perspective. And what I worry about that, and I think about internally how we look at it, and I think about other preparers in the room, like if I talk to the gentleman to my right, how they talk about their business is probably going to be extremely different than how my management team talks about their business too. And what I worry is that by breaking it down this way and having us describe it, is what we'll have to do is that information will then be public. And then what that'll do, you'll have a circle reference and where the executive team will say, well, geez, Scott, like now I need to know about this because this information's public. So it's more almost telling companies like, hey, if this information's out here, now you have to speak to it too. So I think that's one of the things, especially when I think from like how these categories are brought down. And I know others have brought it up too, which is why, like if you think about it more from segment reporting and the basics of what dictates that is, well, no, you start with how management looks at their company. And honestly, the way management looks at their company is how they talk with their investors too. I know I hear comments from an investor's point of view too, but I will say, and I'm not in investor relations, but they would probably, the individuals in that group would probably say, Scott, if the investors have a question, they're going to ask the question, regardless if it is out there or not. And I will tell you with these categories, these are not the type of questions that we're getting.
Yeah, just before we go to Holly, I see Rich, you've got your tent up, so.
Yeah, and just as we go through this, an alternative approach that we didn't pursue, but I've often wondered, is most of the categories we're talking about, you're disclosing a total today. You may have depreciation sitting in your statement of cash flow, you have amortization in your statement of cash flows, you have pensions, you have OPEBs, you have stock comp. The one we're missing is cash comp. And one of the alternatives would have been simply require you to disclose for each of those items where in the income statement they appear. We do that for lots of others. And I will tell you, the benefit of hindsight, 50 years ago, we should have done it. right? For every single disclosure we had, would say, tell us where in your income statement or whether it's capitalized. We're attempting to come at it from another way. But I'm curious, would it be easier if we just said, hey, for that stock comp note, tell us exactly which line items the expense goes in or whether it's capitalized? For the pension and OPEB, tell us the same thing. Here's a new definition of cash comp. Please tell us your total amount of cash comp and where it appears in your income statement. Or for your statement of cash flows, you have depreciation and amortization. Do you know how much of that goes through the income statement versus gets absorbed into your inventory? And could you map that? So there's another way to get to almost the same thing that, and maybe that sounds easier. I don't know. I think it gives you all the same issues. But I just wanted to point that out. And if you think that's a better answer, we'd love to hear it. But I think you go through all the same work.
I just wanted to share some clarifying information. I think we too are very much supportive of further disaggregating costs, realizing that they're presented at a very high level in the P&L line items. But the specified breakout or the costs are a bit challenging. And when I say maybe not as decision useful for my particular company, 80% of our COGS is inventory, and it's finished goods that we, product purchases, the very little manufacturing. Employee costs represent less than 4%. Really, the next most significant item is our logistics costs, our warehousing, and that sort of a thing, inbound or outbound freight, things like that. So it feels like it would be a little bit more useful to use some sort of threshold or mechanism of determining what are the significant costs within there and maybe disclosing those by amounts versus having an arbitrary specification of what those costs are. And employee costs where they are material in a line item would be potentially one of those costs, but.
So Matt and then Jim.
Yeah, I think on sort of question 4, I think one of our big concerns that we had in our comment letter is that for some companies that this really could result in like insufficient disaggregation, where for lots of totals, you'll have very big balances of other for every single caption. And then you'll have a kind of qualitative description of that. We'll get to that later, but that's, not tremendously helpful. So what we urged is, that if a full natural expense disaggregation a la what is required for not-for-profit entities would be far more useful, as there would then be you'd be able to really achieve the objective of, okay, let's look at labor costs versus raw materials versus energy versus, et cetera. I still think where we are in the proposal is it's not quite functional, but also not quite a natural expense disaggregation. Like inventory purchases is not really, so it's still, with this degree of aggregation there. But, to echo some other points, better than what we have today. On totals, I think, so this is what's in the proposal for under IFRS, for there to be a natural expense footnote that would just have totals. It's interesting, but it's not disaggregation. It's just a different view of the income statement, and it's not reconciled to the functional one. So it's like, okay, which one, okay. So it's just telling someone the same thing, but in 2 different languages. And again, the not having the reconciliation there kind of hurts the decision usefulness. Then just like a last point, I just looking at comments over many years or whatever, I'm not sure how to interpret the sort of philosophy that, well, systems are keyed to the current requirements. So therefore, does that foreclose any new requirements, like ever? Because, well, that would require systems change. So I don't know. Like some of this is like news in terms of, I guess, our systems not very flexible. Perhaps that's that's a concern. But so yeah, I'm not sure then how to, how exactly to interpret that. That the systems are only tied to the current requirements. So therefore, it means that no, there can't be any new requirements.
Jim.
So I guess I struggle a little bit with a management approach as it relates to disaggregation of net income, which is done pursuant to GAAP, right? We've already got a number called cost of goods sold. I guess if management is doing a disaggregation internally, probably wonder why, if entities were disaggregating that today, probably wouldn't find ourselves here. But what we do see, and it obviously varies, you know, in some cases we see 5 or 6 expense categories, but I think in many cases there's 2. There's cost of goods sold and SG&A. So and I can't fathom that investors aren't interested, as we've heard, in more information about 2 expense categories. I don't know how to do that when you say, well, management looks at it on a non-GAAP basis or some other basis, but I suspect if management had been providing that disaggregation, we might not find ourselves here. But I do think that nothing precludes, I think in this standard, I think we were clear, but if we're not, we should be, further disaggregation. So for example, if logistics is important to you and management is using that information, I don't think anything in the standard precludes it. I think what we were trying to do is stop short of saying, well, you have to do a full disaggregation of all of your income statement into every potential natural category. We'd pursued that. We didn't think it was particularly effective. So we tried to pick ones that broadly across industries were the most likely to be material. We know for some it won't be. But again, I don't think anything precludes further disaggregation, not in this project.
Paul?
Thanks, Mary. I guess, struggling to connect dots in my head. I've heard a number of folks around the table, and I think, Gary, as you reported in a number of the comment letters, companies are reporting they'd have a lot of difficulty in getting this information, reconfiguring systems, and the like. And what I'm having difficulty reconciling that with is our books and records requirements. I don't recall having seen issuers declare that they are out of compliance with our books and records requirements. So I infer from that management is making a positive assertion that they are in compliance. And so as I read it, it says that every issuer shall make and keep books, records, and accounts, which in reasonable detail accurately and fairly reflect the transactions and disposition of the assets of the issuer. I think compensation is a transaction with somebody. So I guess I'm struggling to understand why it is, on the one hand, an issuer might think it is in compliance with our requirements to maintain books and records in reasonable detail, but yet can't get that information. So any perspectives on that, so I could perhaps connect the dots better, I would find very helpful.
Christine?
Yeah, just a couple of thoughts. When it comes to the decision to have the required categories, we identified those based on the items that were requested most often by users. And so employee compensation, depreciation, amortization were, and the DD&A were the categories that came up frequently that investors said across the board, these are the items that we want and need. And there was also that consistent refrain from investors that we need the comparability and we need the consistency. And so as a board member, I was comfortable supporting those requirements because I thought that it would be very responsive to what investors had asked for many, many years from financial statements. But I shared the concern that I think it was Matt brought up about the magnitude of the residual, and that for some entities that could result in a very large residual because maybe employee compensation is only 4%, and it's just not that significant. And there is another expense out there that we haven't identified that is going to end up in the residual. And so I actually would have supported a requirement to require further disaggregation of that residual based on threshold. So any expense that's in that residual that comprises, let's say, more than 10%, of the total expense category, that entities would be required to disaggregate that. And that would provide for some flexibility then across companies, because if logistics is large for one company and not for another, you would get that disaggregated. Because of cost concerns, there was not a majority of support for that decision. But, those are the kinds of discussions that we've had throughout this project, and the balance, I guess, that we've tried to find between cost and benefit. And then the last thing I wanted to say was, I think Jim and I may be the only ones, Jim Croker, that have been around long enough to have been here for the entire journey so far on this project. And when we added the project back in 2016, we did extensive field studies with companies at that time, where we went out and we tried to understand, what were the systems challenges, the allocation problems, the acquisitive nature of some companies, and the mergers and acquisitions, and the multiple systems, and all of that. And after we had done all of that analysis, we had to take a really hard look at this project to say, okay, we know there's going to be cost. Clearly, there is going to be cost. We had that information in front of us. Is the benefit going to be sufficient in order to justify that cost? And that's a decision that each of us had to come to based on all of the information that we collected from preparers and auditors and investors along the way. And I can only say for myself, it's not that I'm not cognizant of the cost, but I am very cognizant of the benefit. And I ultimately came to the conclusion that the benefit will justify the cost, particularly once we get over the hump of implementation, and that we can deal with trying to get over that hump of implementation through, providing more time, maybe a phased effective or whatever. So we can figure that out. But I just wanted to sort of recognize that it's not that we expect this is going to be done costlessly, and that the information is if it's not there yet, we recognize that there's going to be costs incurred in order to get that information. But the other side was the benefit and how important this is to investors.
So I see one last 10 up. So we're going to do Matt. Matt, you can wrap up this section and then we'll move on.
Yeah, pressure's on. Inspirational close right before section 2. In this section 1B, it's hard to generalize, right? Investor needs are diverse. Preparer systems are also diverse. I just want to be explicit about that. I think this is part of the inherent part of the challenge in this discussion. How many ERPs does Paul have? How many do I have? How many does Joe have, right? It's the inherent part of this dialogue, right? I think it's in the way of the discussion. But I do want to just clarify that depreciation, amortization, employee comp in general are easier to accomplish because there is a discrete subledger activity, to your books and records comment, that you can grab from. And for the auditors, accountants in the room, it's akin to kind of carve out financial statements. It's kind of how I view a lot of this project, right? My general ledger has none of these natural accounts, none. And whether that's a pity or not, it is what it is. But I then have to create carve out techniques, right, to kind of grab this information. I think it's the most succinct way to kind of explain the prepared dilemma that we're working through on this, right? And so I think for these areas, because compensation, depreciation, amortization in general, I'm sure there's some unique prepared areas where there's some nuance that I'm overgeneralizing. You can kind of skip through allocation methodologies, standard costing, multiple ERP systems, and just grab those source systems to comply. Does that make sense? So I hope that advances the discussion a little bit, because I just wanted to help frame, I think that part of the dilemma of this discussion is we all have different ERP system advantages and limitations.
Matt, just to follow up a little, because we got some comments about, for some, totals might be easier. And I know, obviously if you only have 2 or 3 income statement expense line items, just intuitively, I sit here and say, well, how hard could it be to take a total and then figure out just directionally how much is in each one of those 2 or 3 income statement line items? And maybe it gets a little bit to what you're saying, is you got allocations and reallocations and other things. Not that you can't eventually get back to a transaction level, but if the expectation was then tracking the transaction level through all of that to do it. And I'm actually wondering if there's some way that we could get across the notion we understand that because of allocation, sometimes things lose their nature, not just because they're capitalized, but that reallocating at the end, if you knew that total, is also an appropriate mechanism to break that back out. I wonder if that helps some people, that it's effectively a top-down approach as opposed to saying, hey, you have to build a system that from the bottom up not only puts things through allocations and others, but then keeps its natural classification versus you do all that, but there is some approach at the end that you could take a logical, I know the total and I know 80% is here. And so if you guys had thoughts on that, I'm interested as well.
I'm sorry, Mary, but just to kind of close the loop and just, I think this may help. If it doesn't, you can tease me at the break. But, you know, if this proposal is reality, I'm not going to change the general ledger structure of P&G based on this design, just a level set. I still have to serve those managers and cost accounting, cost center leaders, right? So I want to make sure you kind of visualize this, right? So then you're going to do, is this a multi-dimensional GL? Most likely not, right? This is going to be creating different, again, carve-out's the best expression I can come up with. Carve-out techniques, right? Data queries, analyses, again, might be harder for Joe than me because he has more ERP than I do. So I'm not trying to diminish the effort, right? But that, I think, is the implementation effort that we're trying to talk up through.
Great discussion. So our next topic is going to be inventory, which is a bit of a detailed topic. So I think it's probably best we take a break now. We're just going to do 5 minutes. For those on Zoom, if you could just turn your cameras off and make sure your mics are off, because the web stream will keep going during the break. So just make sure that's off. And we'll come back promptly in 5 minutes, everyone. Thank you. All right. Thank you, everybody, for rejoining us. We're going to continue our discussion, and I'm going to turn it over to Maddie, who's going to kick us off with inventory.
Thanks, Mary. Topic 2 is broken out into 2 subtopics. The first, topic 2A, is on inventory and manufacturing expense, and the second, topic 2B, is on the further disaggregation of inventory and manufacturing expense. I'll introduce topic 2A and then hand it over to Adam to provide background on topic 2B. We will then open up both subtopics for discussion. Starting with topic 2A, and as Gary mentioned in the introduction to topic 1B, the DISE proposal identifies inventory and manufacturing expense as a required expense category. Inventory and manufacturing expense would comprise both inventory expense and other manufacturing expenses if applicable. The proposed update defines inventory expense as an expense resulting from the derecognition of inventory due to sale to customers, consumption in the production of goods or services for such sale, or remeasurement, for example, an impairment in accordance with topic 330. The proposed update does not define other manufacturing expenses, and therefore an entity would be required to disclose how it defines those expenses on an annual basis. The board decided to combine inventory expense with other manufacturing expenses to mitigate implementation costs. The board understands that manufacturing entities may combine and then allocate directly to cost of goods sold certain manufacturing costs that are potentially capitalizable depending on inventory turnover rates and production levels. Previous preparer feedback indicated that it would be difficult to quantify whether those indirect costs and variances were capitalized to inventory or expensed as incurred during a reporting period. Therefore, the board decided not to require that entities separate manufacturing-related expenses from costs capitalized to inventory and determined that entities would define other manufacturing expenses for themselves. Investors broadly supported the inclusion of inventory manufacturing expense as a required expense category. Some investors stated that having visibility into variable expenses related to inventory and manufacturing activities would help them better understand an entity's incremental margins, as well as more accurately assess the effects of changes in economic conditions, for example, changes in commodity prices, on an entity's operations and profitability. Many preparers and practitioners indicated that both the definition of inventory expense and the requirement for an entity to disclose its definition of other manufacturing expenses are operable. However, some preparers and preparer-focused trade groups expressed concerns about the ability to separately disclose inventory and manufacturing expense from the other required expense categories. Those comment letter respondents highlighted challenges related to vertically integrated value chains and intercompany transactions. With that, I'll hand it over to Adam to provide background on the further disaggregation of inventory and manufacturing expense.
All right, thank you, Maddie. The DISE proposal requires an entity to further disaggregate inventory and manufacturing expense into the following categories based on costs incurred in the current period: purchases of inventory, employee compensation, depreciation, intangible asset amortization, and DD&A. Because the disaggregation is performed on a cost incurred basis, the cost categories would include amounts that have either been capitalized into inventory or expensed in the period. In order to reconcile the costs incurred to inventory and manufacturing expense, the proposed update would require an entity to disclose additional reconciling line items, which would include other costs capitalized to inventory and manufacturing expense that are not included in the required cost categories, changes in the inventory balance, and other adjustments and reconciling items, which would include items such as foreign currency translation and the derecognition of inventory from items other than a sale to a customer. Most investors supported the further disaggregation of inventory and manufacturing expense using a cost incurred approach because that approach would better align with the timing of an entity's cash flows. In addition, investors explained that the disaggregation of those costs would provide greater visibility into the factors affecting an entity's gross margins and would allow for the application of different assumptions for each cost category when forecasting future results. Some investors recommended that additional cost categories be included in the further disaggregation of inventory and manufacturing expense, including utilities and energy, freight, packaging, commodities, and provisions for inventory. In its initial deliberations, the board considered requiring raw materials as a separate cost category, but decided that requiring this category would be impracticable for many entities for which it is difficult to meaningfully distinguish the proposed further disaggregation between raw materials, work in process, and finished good inventories. In addition, some investors recommended that the proposed further disaggregation requirement be expanded to other costs that are capitalized to assets other than inventory, such as software costs. Nearly all preparer and other comment letter respondents expressed concerns about the operability and costs of further disaggregating inventory and manufacturing expense, some of which we've heard here today. Specifically, most respondents raised concerns about systems limitations, cost pooling and allocation transactions, inventory costing methodologies, and intercompany transactions. In addition to that general feedback, many comment letter respondents expressed the following concerns. First, systems are often designed to report functional costs when they are expensed in the period and not natural cost categories when they are incurred. Next, entities with multiple operating locations or subsidiaries may have intercompany or cost pooling transactions, which often obscure the visibility into the nature of the underlying costs that are incurred. Next, identifying and disclosing the purchases of inventory category would be challenging and costly. For example, some respondents highlighted the following. Many systems do not tag inventory purchases separately from other inventory transactions, such as labor and overhead allocations. Standard costing methodologies will result in challenges for identifying and disclosing the incurred purchases of inventory because the purchase price is split between the standard cost, which is recognized on the balance sheet, and any variance from the standard cost, which is recognized on the income statement. And the term purchases of inventory is not defined within the proposal, which may result in inconsistency and comparability issues across entities. Lastly, significant direct and indirect costs would be incurred, such as ERP vendor costs, costs to develop new processes and controls, and costs related to the audit of internal controls in order to update or redesign the entity's systems for the proposed reporting requirements. Additionally, respondents questioned whether the information provided for the further disaggregation of inventory and manufacturing expense would be decision useful. For example, those respondents noted that the information is not typically requested by an entity's investors or analysts, as we've heard here today. The information is not consistent with how an entity internally manages its costs or assesses performance. And the further disaggregation is not intuitive and therefore may limit its decision usefulness to investors and other users of the financial statements. Some respondents provided recommendations and/or alternatives for the further disaggregation of inventory and manufacturing expense. Those recommendations and alternatives included providing an option to further disaggregate inventory and manufacturing expense based on the amounts expensed on the income statement, requiring a separate inventory roll forward to provide additional context over the further disaggregation. When substantially all of the entity's inventory and manufacturing expense is the result of a single cost category, either requiring a qualitative disclosure of that single cost category or a qualitative disclosure of the required cost categories. Next, not requiring the further disaggregation when an entity already presents inventory purchases or a similar caption on the income statement. Next, applying a threshold to total assets, total revenue, or inventory and manufacturing expense under which an entity would not be required to provide further disaggregation. Or lastly, allowing an option for entities that report under IFRS to provide the disclosures required by the IASB's forthcoming standard instead of the FASB's proposed standard. And so with that background on the feedback that we received, we'll now go ahead and open it up for discussion for questions 9 through 17 in the handout, which relate to the operability, auditability, and decision usefulness of inventory and manufacturing expense as a required expense category, as well as its further disaggregation in the current period.
Yeah. Thanks, Maddie and Adam. So we've got a lot of questions here on inventory. We teed them up together because I think there's a lot of interrelation between the questions, but maybe we could start with kind of the base level questions, which the inventory and manufacturing category, just those requirements to have that be a required category, allowing management to define it, whether it should be inventoriable costs or include period costs, just any thoughts kind of on that category, and then we can get into some of the other details. Matt?
Yes, we support the having inventory and other manufacturing expense or a concept like it as a required expense category. Though I think we are a little unsure as to what would be considered other manufacturing costs that would be then separate from the rest of cost of sales, because I guess then there'd be a bunch of non-manufacturing costs or so. We basically, what I'm saying, I think, though, would be open to simply having inventory expense be the required expense category, as that's clear and it's further disaggregation and relationship to the inventory account on the balance sheet is clearer and wouldn't then single out manufacturing activities or wouldn't require an entity to then classify certain things as manufacturing and non-manufacturing. So we definitely support its further disaggregation, because whatever it is, because inventory expense is a highly aggregated category. It's it's neither natural nor functional. It's kind of an accounting creation, and so it's a heterogeneous item, and that's difficult to forecast. And we would what we put in our comment letter, we would support the further disaggregation of depreciation, amortization, and DD&A using a similar methodology to ensure that capitalized costs don't escape disaggregation. I think this point was brought up with capital intensive businesses where lots of costs get put into tangible assets or intangible assets, and then they would just go on the income statement as depreciation and amortization and sort of disappear. And definitely would strongly support a inventory roll forward to help, because using this cost incurred model, it could create some confusion because it's a different basis than the cost expense on the income statement. So I think that would help contextualize it. And however, understand this is probably the most challenging part of the proposal. So I think we would be open to a tiered effective date framework that I think was mentioned in the comments.
And that's helpful. I think maybe just before we pass around for more comments, some additional perspective. And I think I see some preparer cards up, and definitely that's where I was hoping to go in terms of operability. Because I think when the board started with the inventory and manufacturing expense, we started with inventory expense, and then we thought about, well, what about variances that are charged right to the P&L? Or what about things like I've got a plant that I shut down, so those costs aren't inventoriable. So we came up with this inventory and manufacturing to try to make it a little simpler. And then I think we heard in the comment letters that maybe it isn't simpler, or maybe there's a way to tweak this. Similarly, I think with the cost incurred, we were trying to solve the problem of, once you bundle something into inventory and it's liquidated at cost of goods sold, how do you unbundle it? So we have this cost incurred approach, but I think we certainly heard from some industries, well, they could just disaggregate their cost of goods sold and bypass the cost incurred. So I think we heard kind of on both sides, pros and cons, like where we were trying to make it easier, where it did make it easier for some, but maybe more difficult for others. So I think that'd be something useful to tease out as we kind of go around and we think about these. So I think, Michael, you had your card up next.
Yeah, I'm guessing other preparers will have this, but this seems to be one where we really need to pause and talk about the cost benefits. I mean, this is the one that gave us the most angst, and probably the other preparers as well, especially the further disaggregation of this category. I think this standard looks a lot different if we don't need to do that. So I think it's probably factual for almost everyone here that the system is going to have to be redesigned, which I appreciate Matt's point on, what do we do with that? Well, I think we quantify that in the cost and say, well, this is a significant cost for all of us. Are we sure that we're really gaining the visibility? Because for all the reasons we've talked about before, the way we look at it, what the investors we interact, we're asking for, all those types of things.
Matt?
This may be interpreted as a subtle stalling technique, and I really don't mean it to be. I'm going to lean in and ask for some trust. But I do wonder, a lot of the standard is written for my company, Procter & Gamble, just to make it personal, right? Very large cost of goods sold, 42 billion, SG&A, nearly 30 billion. Jim, to your point, those are the two lines. Those are the only two lines. But there was a lot of preparers from other industries here that are kind of getting lassoed into this dialogue. And I don't want to break this project into the 12 parts. I'm sure, Rich, that would give you palpitations. But I do sometimes wonder whether it's more productive to do this industry by industry to kind of focus through this, because there's other areas that are low-hanging fruit in my industry that we could really clarify, right? Logistics cost. Is it SG&A or cost of goods sold? That's a headache for investors because it's inconsistent today. It's not addressed here, but I sometimes wonder, and I'm not trying to recreate industry gap. I know that's, but I sometimes have a little bit of a sympathy when I look around the room that there's other companies that are not quite the bullseye hit that this standard is, that get kind of drugged into this model. So I just wanted to see how the board's deliberated on that from an industry point of view.
Joe?
Thank you. So I'd like to go back to the cost discussion that I know some of the preparers have done a good job of summarizing, and that was well summarized in the prepared materials, and give you our perspective that, which has already been reiterated, that a lot of the systems are not currently configured to efficiently gather this information and present it in a way that would meet the proposal for a variety of reasons. We think that the staff should endeavor, as part of its cost benefit analysis, to speak with the ERP providers to get an understanding of the makeup of its customer base, to understand, for example, what fraction of its ERP users do already have the configurations to be able to relatively simply implement this, versus what fraction of the user population does not yet have the information available. And I would say that we fall into that latter category. And let me explain what that means. I mentioned in my letter here, my company is in a much different position than Matt's. Matt is, I'll speak for you, largely a single ERP instance. My company has 90 ERPs as of today. We acquire 3 to 10 companies per year that each bring their own ERPs with them. And part of our integration strategy is usually to not integrate those ERPs into ours. We have 25 instances of SAP, 13 instances of Infor, 10 of Oracle, and you can continue to go down the line. We are concerned that if this proposal is implemented as currently proposed, that not only the raw cost to change each of those ERPs, in some situations we may decide that we need to, earlier than planned, we might need to sunset the ERPs and move them to another one. And those are costs that are not being borne as part of our overall strategy and how we create value as an organization. They're being kind of thrust upon us as a result of a regulatory requirement, which we feel like does not, on its surface, pass that cost benefit analysis. But we would also ask the staff to investigate, perhaps with discussions with the ERP providers and the consultants who help with the implementation, is, are there enough resources, once we know that population of companies who do not have ERPs are currently configured to be able to gather the data, are there enough consultants in the universe to run the projects to meet an implementation deadline? And I would like to spend some time in topic 5 on scope for private companies as well. But we see this as dramatically different than, let's say, 606 or 842, where yes, there were simple system implementations, but those costs were relatively minor compared to the what we acknowledge as the benefits to the user community, the preparers and the investors. This one seems to have shifted where the fulcrum is in that scale so dramatically as to impose extreme costs on the preparers with what we believe to be relatively limited benefit for the investors.
And I think that message came through in the comment letters. And I think we took that away, and why we've got a good chunk of time for this topic. I think we understand that this is, a costly proposal as exposed. And I think what we're hoping to do here is try to figure out ways to move the ball forward to, okay, if this isn't what's feasible, you can understand from the proposal what we're trying to shoot at, what we're trying to get investors, what is feasible. I think Gary mentioned, or sorry, not Gary, Adam in his tee up, some of the things that people proposed, is an inventory roll forward more feasible? Is it just looking at cost capitalized inventory or more detail on period costs? Like, what are the ways that we can make something workable? Because I think we understand the challenges. I think, we all have experience, with working at companies and in audits and understand inventory systems and standard costing, but not certainly to the extent that you all do, that live and breathe it, every day. So as you're thinking about like how your ERP or your systems are configured today, what kind of data would be available? Or, if you took our proposal and you tweaked, one or two things, does it drastically change the cost benefit equation without really impairing what we're going to give to users? So I think really we're hoping to learn something on that. So when we come back to the board, we can say, here's some constructive suggestions we've heard. We understand, and cost of goods sold is a huge expense, and it's kind of a black box without any detail. We want to get investors more detail, like how can we do that? So if there's any, we're certainly happy to hear suggestions today, but that's kind of our objective of this session. I think we understand that this is probably the most challenging aspect, and I appreciate the comments. Michael Cleary?
Yeah, I just want to comment to the importance of maybe the definitions of some of these things here, because, for example, let's say for a U.S. government defense contractor, the majority of our costs are now bought to a specific contract. So in certain programs, let's say we're building a certain military aircraft for a customer, we will just buy product for that. And so as such, after we went down 606 path, we used to be sort of more of a ship. We would build it for inventory, and then we would recognize revenue when we transferred it to the customer. But more or less the whole defense industry in the US went down this, we changed our method of revenue recognition. So I do think that these definitions are going to be very important. Now we have a commercial, let's say contrast that we have a commercial spare parts business, and that's just your traditional ship and build business, which probably would fit a lot more easily into these traditional models and definitions. But there are a lot of these very, unique industry aspects that will make these definitions workable or not, because even the notion and we, even in our commercial businesses, we do actually have period cost included we have recurring period costs, as well as the types of things that you just mentioned that do make their way into cost of sales. So it's a cost of sales for us. It's not just inventory.
Scott?
Yeah, I think one of the things too is when I look at some of these costs, and especially like that additional drill down on information on inventory expense, like I think at least from our perspective too, like that's where you start getting into a lot of the cost aspects to it. So it's really that double click. And when you try to then figure out, once things make their way into inventory and all the things that were discussed, that's the hard part of it. And that's the part where you get into like the ERP systems, at least from our perspective, and be able to break that out. And even further, that point too is in order to break that out and then be able to reconcile that back to get to an auditable number. Like I know we have audit firms here, and I'm sure they would say, yeah, if the company can produce an audited number, we'll audit it. But the reality is like, being able to get that information when you get to a double click from an inventory side. So I think for some of these things too, especially if you take like the first glance at it and some of the categories there, like amortization, like those are things we already disclose, like employee costs, like incurred, like that first maybe layer of it is maybe a little bit more operable. But once you get into like inventoriable costs and trying to get to incurred to expensed and reconcile that, like that's where I see a lot of the difficulties come into play.
And we took this, like we talked about with the approach from this perspective of like, let's take cost of goods sold and drill in, but a lot of this does relate to inventory. Do you see like a difference if we disaggregated balance sheet information, like what's coming into inventory versus trying to focus on the cost of goods sold and the cost incurred? I'm just curious if is it equally difficult? Is one marginally better than the other?
Yeah, I mean, it's hard for me to say on that one, because I think where my mind goes to a lot of times when we talk about inventory cost is like, it gets me back to like, is this actually helpful information for somebody? And obviously that's something specific on our end too. But what I will say is like, inventoriable cost is not, even when I look at like cost of goods sold, like that's not the biggest number in there, right? Like we have amortization, which we break out separately. We have a lot of collaboration and profit sharing, which that's really one of our bigger numbers that we have in cost of goods sold. And we disclose that separately too. So I know there's been comments too of like, hey, there's not this disaggregation there. And I kind of would say, you know, in certain cases, like we try to disaggregate some of those bigger items, but now when we start talking about inventory, that's not as big of a driver. But if we go down that double click, then we're going to be dealing with a lot of costs to get insight on a number that really isn't an overall driver from a business perspective.
Joe, is your flag from before? Okay, go ahead. Go ahead.
Yep. So I think if the proposal had been written in a way to say you need to disaggregate COGS and do it in a way that is meaningful for your company, I think that our company would have gravitated toward concepts that are broadly applicable in manufacturing entities. And that is, we probably would choose to invest time in our systems to identify those items that are loosely defined as direct materials, direct labor, overhead, and other. And I think that some of my underlying components are already ready for that, and others would be relatively small steps to get there. And you might be saying, well, that doesn't sound a lot different than what we're already talking about. I think there are pretty significant differences there, and particularly if each preparer were left to its own devices to define its subcategories and explain how they're used, I think we would find it a lot more palatable to use terminology that's relatively consistent, but also company specific.
Greg?
Yeah, you know, we're a little bit different in the oil and gas space. Maybe the feedback around inventory and disaggregating on the manufacturing expenses is a nightmare for my friends here in the room. That's my concept for compensation cost. But I think the principle still holds in that, as Jeff was talking about ARPs and Matt was talking about having to do carve outs, I think that all kind of pivots us really back towards a workable solution would be to allow companies to have flexibility. And so if I look at Exxon, for example, and if David over there from Moody's is wondering, well, gosh, how much does it cost to operate a refinery, which is probably a more informative disclosure as opposed to what our inventory cost is, I think we could naturally disaggregate some of that information that would be, again, aligned with management's view of the business and how they steward the enterprise. If we have to come in with a prescriptive approach that requires additional information that exists somewhere in the universe, but we have to copy and paste it together, that's where we run into the technology concerns, right? And kind of how I think about it is, first of all, for Exxon, it would be hundreds of millions of dollars to implement the standard as written. And that's just a very rough estimate, and it's probably low, right? That the number would definitely grow over time. But then we would ask, well, what are we really going to do with that information? Because as I look at a extractive company like Exxon, what informs our value? It's our production, it's commodity prices, and it's refinery utilization. Compensation cost, while material to the company, does not drive or provide an indicator to our performance. So I think that, again, you know, I'll come back to, we really want to advocate for flexibility. And if the goal is to produce something that's operable on a sooner time frame, I think that's where flexibility has to come into play. Because otherwise, you know, our feedback is the runway here would have to be extremely long. I think someone earlier in the meeting mentioned 3 years. We're thinking 4 to 6, somewhere in that neighborhood. And that's probably misaligned with what the investors want, right? So if we want to give investors additional disaggregated data, I think let's work with what we have as opposed to trying to create something from old cloth.
Christine?
Yeah, so we did consider the management view pretty seriously along the way. And some of the issues that arose, and I'd be interested in hearing, if there are solutions in the room to these issues. But some of the issues that arose was, first of all, when we say management view, management at what level and for what purpose? So, the investors are looking for this information primarily for forecasting. So, should we say, well, it's the information that management uses to forecast, which might be different than at the CODM level. If the view is, well, we should be looking at the CODM level to be consistent with segments. In our recent segment reporting project, when we talk to preparers about the information the CODM has given on significant expenses at the segment level, about half said their CODMs don't get expense information at the segment level regularly provided. So if we were looking at it from that perspective, then presumably that would imply that, half of companies wouldn't have anything to disclose because at the CODM level, the management isn't getting expense information. At least that's what we've been told. So I think that was part of the problem with the management approach was, what level do we strike that out? For what purpose is the information? If we've got to go lower in the organization to get the disaggregation, how low do we have to go? How do we write a standard around that? And then there's still the issue of comparability and consistency for investors, which is something that they really wanted. So if there's thoughts on how we could have resolved those issues, but we talked to a lot of preparers and we didn't make a lot of progress.
Yeah, and I think, Christine, we explored the management approach, and then we also explored, I think, similar to what Joe was describing, is kind of a disaggregation principle similar to RevRec. So what if we just put some broad principles and let management define how to do it? And we drafted that and did outreach on it. And I think there was a lot of discomfort on, well, how are these going to get audited? And how am I going to come up with my categories? And how do I justify it? And there was a desire to have more prescriptive guidance, to have some safety on the audit side. But then we get in this like little bit of a do loop of, maybe it's more operable, but then it causes audit challenges. So I think we've explored a lot of things, but like Christine said, we're happy to hear feedback, because I think we've been at this for a while. Michael?
Yeah, maybe just on that last point. Yeah, maybe when you see the alternative, the thing that came first looks a lot better. That's maybe on that. On the forecasting comment, yeah, that's something that we struggle with in thinking about this as well, because we forecast and think about these categories interdependently, and so it's as we're putting out guidance, so it's a little bit difficult to think. We don't forecast these separately. We think about how they interact with one another. And then on your comment on the balance sheet approach, Mary, I don't think that ends up being any easier. I think it just shifts. And I think we could probably get some good evidence on that. Inventory roll forwards often have to be done for a short period of time from physical count to year end, and they're usually painful and manual. So we could probably get some perspectives from people that have had to do those. And then just lastly, someone else had made a comment. I think a one-click level down as opposed to 2 in this area, I think significantly alleviates the operability. Thanks.
Jim?
One of the things that it was in a lot of the letters, right? Flexibility or management approach, but I'm really continue to struggle with what that looks like. It's hard for me to imagine that in a management approach, you're not looking at materials. So that's a disaggregation category. In most cases, labor. And then I would have thought, perhaps we didn't capture all of overhead because we only did depreciation and amortization. There are other components of overhead. But, one of the things that would help is perhaps taking some time and crafting what you think a flexible approach would look like in your current income statement environment. Because it's hard to just accept, we'll do flexibility, and then it comes back to, well, we just managed the total COGS number. And I think if we went around this room, investors would tell us perhaps the most important number to disaggregate for a manufacturer would be COGS. Not, I mean, they're going to want SG&A as well, but I can't believe that their analysis is done on total COGS. In fact, MD&A isn't a total COG basis; it's the drivers, and so I can't fathom that we can't do a greater breakdown than what's happening today. And I think we took the largest components of inventory, you know, short of perhaps adding some other things that investors asked for, like lease expense, which is probably for many bigger than some of the ones we captured. For others, probably the next in the level. But I just don't envision what this give us flexibility really looks like.
So I don't know if I see a couple, Michael and Greg with your flags up. I don't know if any of you have a Michael, if you want to go next.
I would say on the total the cost of sales aspect, that, you know, if there was this requirement for management to provide a meaningful disaggregation of cost of sales, I do think that it would come back to things like materials, labor, and overhead. I think when you get into things like depreciation, like if we walk into the factory, if I walk out into one of our factories, I can see the equipment there. I know that the depreciation associated with that equipment is, you know, that's going to be included in that cost of sales. But then there's the building, then there's the engineering group that support manufacturing, there's quality, and they all have use and occupancy allocations. So I do think that if there was sort of an approach that said, management, you have to provide a more insightful breakdown of the drivers of your income statement line items, and maybe if you have big inventory, things like that, that would be more doable, because we could start at least with trying to extract what information we could and supplement, rather than create a whole new, you know, clean sheet set of systems that would enable us to get this types of information. And then maybe just one comment on the forecasting question again. I mean, like for most of our companies, like I think we're all sort of volume driven, and a lot of our costs are volume driven. So typically, I think we do start off with our forecast. Well, what's our manufacturing or production plans, and what's our backlog? That's sort of how we tend to build up. And then, you know, there's these items of expense that, you know, they're sort of recurring, ongoing. But we don't, you know, we think about, well, if I'm getting into a new product line, I have to build this new factory, I have to hire people, I have to train them. So that's sort of how you do it. I mean, that's sort of how we approach it. And I think that's why when the analysts follow our company, they try to understand the product lines, they try to understand where we're going with those product lines, what stage they are in the life cycle. And so maybe, you know, I get the concept. We have revenue disaggregation where we use this management approach. And if we say, well, yeah, we got to have some, you know, similar some type of disaggregation that is meaningful for cost of sales, I think that's something. And then when you get into, you know, what types of costs are included in G&A, what types of costs are included in your R&D, I mean, that is doable. I mean, that we can at least get our heads around, here's how we might be able to make something like that operational.
Greg?
I was going to pivot back to Christine's point on forecasting. So I do have visibility into our forecasting process. And what I can tell you is it is a bottoms up analysis, right? So if we're thinking about maybe a chemical plant expansion, and how are we going to forecast those costs? Basically starts at maybe the plant manager level, and he goes through, or she goes through all of the detail, aggregates that all up, and that continues up the chain. Our management doesn't just receive, executive management doesn't just receive information consistent with what we see in the segment presentation, which is like, you know, basically disaggregated income statement, or an income statement consistent with the face of our primary. They do see information beyond that, but that's made in the context of FID or final investment decisions, let's say. And the disconnect, I think, with what we see here is that maybe there's an assumption or a presumption that this information is meaningful to all companies. And that this will kind of maybe tie into Jim's point earlier around, well, if we're advocating for flexibility, what exactly is flexibility? And in my opinion, flexibility would be what's meaningful to the company and material at the same time. And so we would be willing to continue to work with the FASB staff on trying to come up with an alternative concept around what flexibility looks like. And I think here a multi-industry group solution would be great. But I can also, advise you, there are some industries that are very different than one another. We don't have the manufacturing costs that P&G may have, right? But we do have a fair amount of product purchases that we purchase to run through our refineries. So again, this is where I think flexibility can come into play and be advantageous, recognizing that this won't be the end of the project. We're not that naive that this will continue on. There will be additional requests for more disclosure on a disaggregated basis as it moves forward. But let's set us up for success as opposed to really trying to create something that we can't deliver at this point in time.
Matt?
Yeah, just on the management approach, like just in general, I think we've been opposed to a full management approach, whether in this standard setting project or in others, frankly. And I think it just comes down to, I think essentially management and investors have different perspectives, and it can actually have different incentives as well. And it comes down to, choose your own reporting. It's kind of like grade your own homework. So we're kind of, however, we do appreciate that, like, there is differences and, we live in the real world. So I think what we put in our comments was that perhaps one way to incorporate this would be to set a prescriptive, I wouldn't say minimum, but to set a prescriptive standard of here are some disaggregation categories applicable to everybody, and then set a ceiling on how much other can be. And in order to get to that ceiling, management can have flexibility. So perhaps you have employee compensation, depreciation, depreciation, inventory expense. That gets you to maybe 60%, disaggregated. And then management would then be welcome to come up with categories of their own in order to get us to 95 or 90% disaggregated for a given expense caption. So that way I think we'd still get that breadth, but I think we'd still get that sort of that minimum or that standard, which honestly is, I guess, similar to the way that, whatever GAAP and the SEC reporting requirements works for the income statement as a whole, of course, right? Where there's this minimum, but companies are of course encouraged to, hey, fuel is a big, you can put fuel on there, right? So I think that's kind of like where we come out. And then finally, just on this, just to echo some points on the management approach again, is that, management approach seems nice, but then it opens it's a whole other kettle of fish, because is it the CODM and because a lot of times investors, at least in our surveys, they've indicated that they think of management as kind of a top level executive team, not just the CEO who is identified as a CODM. So it could include like some divisional management, et cetera. And they also, I think we're all kind of aware that it's not just, like how complete is the information should be, because, investors are at least aware that it's not the entire package that management's getting. It's the subset. So like what goes into that. So I think a management approach actually just creates, I think, like you were saying, like it creates a whole other set of questions. So it may not actually be simpler.
Holly?
Just a couple points. We're in the middle of a massive ERP project. We're in year 6 and we still have a few years to go. So this isn't like a short-term switch. And then I wonder if there's a way to delineate management approach and how it's used in segment reporting versus how you decide what categories should be disaggregated further. And I think it needs some thought, like I'm riffing a little bit, but I think that, if we look at the questions we get from our investors and analysts, and we spend a great deal of time explaining margin walks, and you'll have a bunch of key kind of factors that explain changes in your margin, everything that are repetitive. And that would be a very good indicator of maybe breaking those out in dollars versus kind of the percent margin walks we do today. I think there's there is a lot of information already provided. But if we wanted to come back and actually disaggregate the P&L more, the example I gave earlier, it would be much more useful to our investors based on the questions that they ask and everything to break out logistics expense and that sort of thing than employee costs. That is not meaningful. It doesn't drive anything really.
Jim?
Matt, I thought your comments were helpful because I think we've gone down that path. And certainly investors, I think, would benefit more. It almost gets to Christine's point on the residual, right? We pick captions that are likely to be across all industries, but variability within any one, the most likely to be the largest. But we could have said, well, entities, you must, and we've gone down this path. I think we got feedback that said, no, it requires a full by function, by nature income statement to say management disaggregate each line into the natural categories and do it based on, how you manage the business, but no amount of the residual can be greater than X percent. And we could head down that path. We've done it before. And I think the feedback was, it's not how management looks at the business that is not disaggregated that way, and that would be exponentially more expensive. So I think this was trying to respond to what are the things that are most likely to be, almost to Matt's point, in subledgers or other systems that are easier to capture, as opposed to saying, well, break out your entire income statement into its natural categories. And I suspect that if we were to go down that path, we would hear even more concern about expense, but maybe I'm wrong.
Yeah, and one of the challenges we heard, it came up more when we were talking about the residual when we were doing our outreach and research, is like, if you set a threshold, I basically have to, like, companies have to track everything to know, like, if they're getting close to the threshold or just over. So that's some of the reason we didn't pursue that, but understand the point that, maybe that's something we take a look at. But we did get some feedback on that in the initial deliberations. We can go to Patty next.
So to take a step back a little bit before we get into what categories should be disaggregated within inventory, we think that at the outset there should be a threshold to determine if you should disaggregate inventory at all. So we kind of fall in the bucket that Matt was alluding to earlier about not being a huge manufacturing company, right? So we have an infrastructure business and we have inventory within that business. However, it's not a driver of our business at all. It's less than 25% of revenue, that segment itself. And from an inventory perspective, we fall right around 5% on the balance sheet. So we do have to separately disclose it, but 5% really isn't significant. It's not material. It's not a core part of our business, this inventory piece of it. So from a cost benefit perspective, having to further disaggregate inventory and go through all the costs that would need to be required in order to redesign our systems to be able to pull this information, we just don't see the benefit there for us.
Do you think in that case, one of the things we talked about, or I guess it was a couple hours ago at this point, was materiality and whether we should provide more guidance on materiality or leave it to management. Do you see that inventory discussion as kind of falling into a materiality call, or you'd say it's material, so you maybe need some additional guidance to give you some coverage on it?
Well, I think that's why we went down the threshold path, right? Because if you were to look at our balance sheet, right, you'd say it is material, it meets a 5% threshold for, further disclosure, but it's really not core to our business. So, and we understand how we should be applying materiality to, this guidance, but really it's how useful is this to our investors compared to the work it would take for us to do this. So can't really say it's a materiality discussion, right? But that's why we are proposing a threshold.
Okay. Thanks for the clarification. Matt?
So Mary, correct me if I'm skipping to the wrong set of questions, but I wanted to just...
We're in the whole
middle.
The whole inventory section, anything is fair game.
So I wanted to just pivot just a little bit to the concept of the overall end-to-end roll forward of these natural elements, right? So, speaking for my company, we talk about commodity cost inflation. That's an impact on our margins. In our MD&A, we'll give you a perspective, whether it's inflation or deflation right now. Labor cost trends, whether that has an impact on margins. So we certainly have, whether it be forecast techniques, Christine, or other reporting systems to give us data perspective of what those drivers are into our margin walk. So I just wanted to level so that's not, we're not like we're blind there. But as I kind of build my carve out methodology from before the break, making carve out methodologies to extract labor cost, depreciation, amortization, and inventory purchases. Today, I feel like I have to hold my breath to then see that that rolls forward all the way through for inventory. That's the part where I have the most concern from an ICFR perspective of, oh my gosh, what am I missing? Did I not mimic foreign exchange inventory this period correctly because it's not running through my natural translation system? Or I did really well this time. That roll forward has some small differences I could explain, but then 3 periods later, it's 4 times as large. That's the part where I just think we're really having a struggle. It's because the underlying ERP systems are not built to serve that level of reporting today, be it wrong or right. There's carve-out methodology to grab that data. There is that today. But then to give it to the overall reconciliation is where I have a lot of hesitation. I totally appreciate as an investor, it's very natural to say, well, show me how it builds into the overall reported amount. But I just wanted to also lay out that that's also just part of my own unease about how to operationalize the standard.
Yeah, I think it maybe just to rephrase a little bit, you could tell me if I'm capturing the sentiment. It's like you can tie your beginning and ending inventory, you can tie your cost of goods sold, but all the components, how do you get comfort in those? And you have to have comfort that you have good controls because there's not necessarily tie back points for every single piece, right? And I understand the point. Okay. Matt?
Yeah, actually just want to, it just reminded me, Matt's comments was that actually one of the, I think, best or most promising parts of this proposal is that I think this would better enable investors to contextualize and understand comments that management makes in MD&A, earnings, investor presentations, within guidance, and so on. Because at least in my experience, often management does make comments that, oh, we're expecting some pressure on gross margins because of labor. Oh, we're expecting, commodity cost inflation is doing X, or in the MD&A, cost of sales increase because of XYZ, and it's often related to something that's a natural expense classification. So, however, it's only qualitative, so we're not actually able to see what apparently what management is looking at in order to make those comments. So I think that this stuff will be read in conjunction with the with MD&A and with comments made in the transcripts, et cetera. So it would really, I think, help. It would really help investors better understand those qualitative comments.
One area we haven't gotten to yet that I want to make sure we touch on is purchases. And just what that represents and if it needs further guidance. So when the board originally was deliberating what should be broken out, there was some discussion on should we have raw materials purchases, finished good purchases, and we just decided to keep it kind of a catch-all bucket of purchases to keep it high level, and we thought that would be more operable. We did get some feedback that asked us to define what a purchase is, but there weren't necessarily any suggestions for how to do that. So I'm just curious from this group if anyone thinks that's a challenging aspect that needs more guidance, if we pursue that as a required disaggregation, or just any feedback on whether there was confusion there. Because I think we weren't expecting to see that type of feedback, but we did get it in a couple of comment letters. So just curious if there's any thoughts on whether that needs to be addressed if we move forward with that part. Yep, go ahead.
A clarification question. Is it, I thought what the requirement was purchases incurred during the period included in cost of sales.
That are going into inventory.
Yeah, or well, it's either one. Is it, or both?
Purchases that are being capitalized
Okay.
as part of
Right,
inventory.
which was part of this issue of trying to separate purchases that are so-called capitalized versus purchases that are ending up straight into cost of sales. So I think that's another complicating aspect.
Okay, so you've got purchases that are period costs and purchases that are in inventory. Yep, gotcha.
We have purchases that go into inventory. We have purchases. Yeah, we have both.
Yep, gotcha. Michael?
Yeah, I'd just say we prefer more flexibility on this, just for the reason that it's already going to be complicated, as Matt described. But we getting things into these categories, so allowing us some flexibility to make some judgments on what goes there, I think would be helpful.
So sorry, go ahead, Fred.
Just to follow up on that, Michael, I mean, we actually decided on this purchases approach in part because investors had told us, boy, we'd really like raw materials. But other board members can correct me, but the idea of what's a raw material and what's a finished good, and was very difficult. And so that's why we felt, came out with purchases as a broad category. So I'm just curious, how much more flexible could we possibly be with the category than?
No, I was agreeing with how it's written. I prefer it not have more prescriptive guidance.
Okay,
allow
so
it
you're
as written. Yeah.
So you're fine as written then?
Yes.
Okay, I'm sorry.
Great. So I think we've had a lot of good discussion on inventory. I think we could probably talk about this for many more hours, but I'll just open it up if there's any final comments on inventory before we move on. I think there's been some good dialogue here. And like I said, we've got a lot of good suggestions in the comment letters. So the team will take back this feedback and continue to work through this. Oh, Brad?
Yeah, I'd just like to add an investor standpoint from this so that the preparers understand kind of what we're looking at, our time frame, and how we view these things. And just as background, I was a preparer 25 years ago, so I understand your issues. But for me, as an investor, what you have to understand is that the higher up the income statement, the more important it is. If this were something talking about taxes, I wouldn't have much of a concern about it. But it's cost of goods sold and it's inventory. And so for me, this is a very, very, very important part of my analysis. And not only from a forward-looking perspective in terms of being able to forecast forward, and this breakdown does enable me to have a view on both fixed and variable costs and incremental margins, which are extremely important for forecasting forward. But also it allows me to see, and we just talked about it, as purchases, which for me is extremely important. And I'll give you an example. And the reason why is that, let's say a company has inventories that are ballooning and we don't know the reason why. Well, if the company says, well, it's buildup from purchases, well, now we've got an ability to check that, right? And I understand from a Boeing perspective, this is a very, very different discussion, right? But from my standpoint, from an investor standpoint, I mean, this is extremely important to me and extremely important to my colleagues and my clients who are on the buy side. It's something that I get asked about a lot. And so I don't think we should be dismissing this as something that investors don't care about it and that it's too expensive for us and this, that, and the other thing. I mean, look, all this data is in the general ledger. We can pull from it. You can pull from it. It might take writing code or whatever, but in my opinion, it's extremely important. And so I just want to say my piece on that so that folks would understand where investors are coming from when we're talking about the specific issue with inventory and cost of goods sold.
Thanks. Matt?
And just the change in inventories line that would be in the further disaggregation. I'm now remembering the proposal. Is there a description required for that or an explanation required to give color on that?
No, I think the change in inventory is just the change in the balance sheet. So it's just math.
Understood.
There's qualitative descriptions for the other reconciling items and the other costs, but not for the change in inventory.
Okay, that is at least something that because I think that some companies, because it's kind of this difference in how much cost did you incur versus expense in a given period, which actually speaks to, or could speak to, is it inventory obsolescence, or is it a decline in demand, or is it seasonal purchasing patterns? So at least we would really prefer to see also some sort of color. Perhaps management would do this anyway, but some sort of color on that, because I think that number could be quite revealing. Just to follow up on what Brad was saying about how why is inventory changing, or why is it changing in relation to, is it from whatever? Well, what are the actual drivers? Thanks.
Any last comments on inventory before we move on? Okay, so I think in the interest of time, because we're running short on it, we're gonna skip topic 3 and move to topic 4. On topic 3, I think we've discussed some of the residual feedback. Topic 3 also related to the list of disclosures that would be scoped in. I think we have a lot of detailed feedback on specific disclosures from the comment letters that we're working through. So we'll be in touch on those if there's specific questions to work through. But just I want to make sure we get to selling because that's probably the next biggest aspect of the proposal. So with that, I'm going to turn it to Mike Lupo to tee up topic 4.
Thanks, Mary. As Mary mentioned, our next topic for discussion is the proposed requirement for an entity to disclose total selling expenses and how it defines selling expenses. Investors generally supported the proposed requirements for selling expenses. Most investors expressed that the information resulting from the proposed requirements would be useful in analyzing entities' expenses. Specifically, investors indicated that the disclosures would assist them in differentiating selling expenses from other general and administrative expenses, performing peer comparisons, and assessing trends. Although investors generally supported the proposed disclosures, some recommended improvements. Most notably, several investors observed that the proposal would not require an entity to further disaggregate selling expenses into the required categories unless selling expenses is a relevant expense caption. That is, unless selling expenses are presented on the face of the income statement. As a result, those investors suggested further disaggregating selling expenses into some or all of the required expense categories, regardless of whether selling expense is a relevant expense caption. Additionally, a few investors recommended developing a standardized definition of selling expenses or providing entities with guidelines on how to define selling expenses to enhance the comparability and consistency of the disclosures. Most comment letter respondents generally agreed that the proposed requirements are operable. Many of the respondents that supported allowing an entity to determine how it defines selling expenses noted that it enhances the operability of the proposed amendments by providing the flexibility to accommodate differences in how industries and entities view selling expenses. Some of those respondents explained that an entity-specific definition would result in more relevant information than a prescribed definition. Respondents that supported a standardized definition of selling expenses expressed concerns about the decision usefulness of the information that would result from an entity-specific definition of selling expenses. For example, some respondents noted that an entity-specific definition would limit comparability across entities. Some of those respondents suggested developing a more detailed framework or providing specific examples to assist entities in determining what constitutes a selling expense. However, while some investors and comment letter respondents suggested further guidance on defining selling expenses, we did not receive any constructive suggestions on how to do so. Some respondents questioned whether disclosing total selling expenses would be decision useful. Those respondents explained that selling expense is not an input to metrics used by management to evaluate the performance of some entities, and that guidance for direct selling expenses already exists in some industries. Additionally, some pointed out that selling expenses may be capitalized into an asset, in which case they would not be captured by the proposal. Question 21 of the handout asks if the requirement to disclose total selling expenses and the related definition of selling expenses is operable and decision useful, and whether there are improvements to the proposed amendments that the board should consider. With that, we can open it up for discussion on the topic.
And one thing I just wanted to clarify, I think we said this is a accounting or it's a, you can determine what your definition is. And we got some requests for guardrails, but I just want to make sure it came through clear in the proposal that the disclosure is selling expenses recognized in continuing operations. So I just wanted to share that we have at least that guardrail. I think some of the questions we got in the comment letters maybe implied that people thought it was broader, because I think we saw some questions about contra revenue, or do I have to start including in this disclosure things that were capitalized? So our intent here was continuing operations. So I think as we talk about it, it'd be good to know if people kind of agree with that as the parameter, and if that needs more clarification, or if you think it should be something different, as well as, we didn't have any suggestions on how to define it or what the additional guardrails should be. So we're open for suggestions if there's particular things. And with that, I see Matt's got his card up.
So the one suggestion I would make is just clarifying whether advertising is part of selling or not. And I just have to be honest. I assumed it was not because there's already an advertising disclosure requirement. But then I talked to some of my peers, they say, no, it is. And I just worry, we're talking like 10 margin points difference of good faith assumption, right? And it's just not clear to me why, if you have a requirement to disclose R&D and advertising, we should at least define is selling, is it sales force or is it the totality of go-to-market activity? And someone has to give me something. I mean, I don't need a prescriptive definition, but at least one bullet point, because otherwise I'm just so afraid in good faith, we're going to give you guys very different numbers because we use that term at different companies different ways.
Yeah. Holly?
Just echoing Matt there, that without providing classification guidance and a definition, it really just becomes an internal year-over-year metric comparing the cost from one year to the other year just for your company. And I'm not sure what the value is there because you can define it pretty much however you want. We separately disclose what's called demand creation, which is all of our advertising, endorsements, and everything. And I think we would end up just saying that's our selling costs. But I could see very easily many other costs that could fall into that definition that are classified all over our P&L.
Christine?
I guess I find it interesting that there's concern about not having a definition for selling when we don't have a definition for cost of goods sold. We don't have a definition for SG&A. Yeah, but when we try to go down that path, what we've heard from preparers is don't define those things because the way I manage my business and what I consider cost of goods sold is not the same as what Nike might consider cost of goods sold. So I guess I just struggle a little bit because to me, if we're going to define selling, then I think that just for consistency, that would take me down a path as a standard setter of saying, okay, well, now we have to think about defining everything on the income statement. And we did start there with this project actually, and ended up not doing that because of the feedback that we got from preparers.
I think one of the other things we were sensitive to, and maybe Holly, you hit on this a little bit, is like some companies include a line item on their face of their income statement. So it's like in cases where that would be your definition, if we provided another definition, then that might cause confusion. But I think that's, there's a lot of variety in what companies put on their face and what they might include that bucket versus whether it would be the same or different from how you disclose selling. Michael Taylor?
Yeah, I guess I'll be one of the preparers that says we are happy with being able to define that because many companies are going to have a different way of looking at it. But then just the other comment is, as you're looking at costs and benefits on this one, this is an area that because it's always been grouped, it's embedded. The selling is embedded in other places. So the definition is going to have to be developed, and then we're going to have to develop a manner of breaking it out. It's not something that's readily available. So just for consideration.
David?
I think the selling costs would be very decision useful, and to have the split of that SG&A, if you just use the words, one of these is not like the other, and disaggregating these types of items I think is really helpful. And when I say these types of items, it's almost in line with how Holly described it. I can't remember the exact term, but things that you're investing into the future of your company or value creation of your company. And we consider this to be a step towards getting some disaggregation on that. As far as prescriptive versus guideline versus open-ended, we think time will solve these problems anyway, but whatever the preparers think is the easiest and best happy medium to get there. But we would like to have some sort of consistent, definition of selling costs. And we appreciate that it is complicated by the capitalization of selling costs, and that could affect certain industries disproportionately, which is, I think, unfortunate. And I think hopefully maybe we just expense those as well someday.
Daniel?
I think it's nice to have the flexibility. I think in the insurance industry, there's really two main costs of sales. It's commissions to agents and it's advertising. Those are the two main items, so we can solve for a very large percentage of that, I think, by, having the flexibility. And I think the FASB's examples in the exposure draft showed there is diversity across industries. So having it more prescriptive, I think, makes a lot of challenges for, certain industries. And we can certainly pull in capitalized and amortized DAC, into our disclosure. We could pull in advertising expense, so having that ability. And then over the course of time, there is benchmarking done. There are conversations, held to kind of bounce questions off of just different companies to say, how are you kind of thinking about this? And I think industries will kind of coalesce around kind of an answer as to this is probably what makes the most sense. And if people are not disclosing something in this, then it kind of raises a question as to why they aren't.
Amanda?
So just to share from that academic research, there's been a lot looked at advertising expenses, which are disclosed, and the consensus is that those expenses are value relevant. And then there's also other studies that looked specifically at SG&A to see whether those were likely to include homogeneous items or heterogeneous items. And heterogeneous items were found to include information around intangible assets, predictive of that, predictive of investments around operating efficiency. So I think the consensus from academic research would support that this would be decision useful to disclose a breakdown of selling costs from SG&A.
Holly?
I think, I'm not sure I totally agree that industry would coalesce around a common description or a common definition of selling costs. We don't around COGS today. Our just our competitors have a widely different definition of COGS. It's apples to oranges. COGS for us is also an internal company specific year over year metric versus trying to compare us to any of our competitors. So I think the same thing would happen with selling costs. And then I question, what are we trying to accomplish? Are we trying to accomplish consistency? Are we just going to disclose the underlying, how we define it, and then how is that used, et cetera?
Matt?
Yeah, so I think we would support a standardized definition, although I don't have one. But I think that however, understandably, I think you'd want to have something that allows for some flexibility within that. So allow a range of reporting outcomes, but let's not let it get really wide. I think something about costs that are intended for current and future revenue generation or something to that effect could be helpful. I think on the disaggregation though of this item, which is not in the proposal, I think some of this was in response to a fear that, okay, what if today you report, as many companies do, sales and marketing separately from G&A on the face of your income statement? And with this incentivize, with the way that this would work with the rest of the disaggregation requirements, is there then an incentive to group those together such that you now only have to disaggregate that caption, and then you can leave selling expenses in your footnote, but it's just in a total? So now, of course, that would assume obviously that assumes a level of bad faith, but that is at least kind of the fear there, and why perhaps requiring its disaggregation would get around that incentive to change the face of your income statement to try to then manage a certain outcome, or to get away from a certain disaggregation requirement. But yeah, anyway, so taking a step back, I think the goal here is that it really just trying to understand the idea is that these are the expenses that vary more with revenue than G&A would, is sort of the idea here from a modeling perspective. So is that okay? So as revenues grow, this one is then presumed to sort of grow with that, whereas perhaps a company, if they're growing or shrinking, that they would get leverage or deleverage on the G&A side, because that's presumed to be a bit more fixed. That's, I think, sort of how this would be used is something about like that.
Mark?
Yeah, I wanted to point out one thing, David. You know this, and when we talk about coalescing the selling thing around at FinRec, we talked a lot about, and David, you said time will fix this somehow. That means that we can continually change our definition of selling, and I don't know whether the standard would necessarily specifically allow for that or not, or whether it would, but you set your selling expense definition on day one, then next year you say, well, you know, my competitor does it different. I want to change it now. Your auditors are going to come in and say, well, does that need to be preferable? Can you just change it willy-nilly whenever you want and just explain what you did? So I think it's important to note that, you know, once you set the definition, I don't know whether it's quite easy to just say, well, next year I'm going to change it because, you know, Procter & Gamble didn't include advertising, but Kimberly-Clark did. So now we're going to include it. Can we do that? I'm sure, you know, the auditors, and my brother's your auditor, but they're going to say, well, can you do that? So, I just, if there's some flexibility in the standard to allow that change and then disclose it, I think, David, when you and I talked about it, you wouldn't have any problem with changing. I don't want to put words in your mouth, but as long as it's very clear what they changed and why they did it.
Daniel?
If there's ambiguity around the definition, I think that's where we've had the transition resource groups and kind of the other things that the FASB has kind of put together around new standards, right? And so that would maybe be more of the medium to kind of say, you know, hey, there's ambiguity around this part of it specifically for this specific industry or for this specific topic. Can we resolve it through those types of conversations?
Matt?
I'm sorry to be stubborn, no, but I'm still confused whether it's fixed or variable. Because if it's variable, it's advertising, which is currently disclosed. If what you're trying to get is what's the brand management P&G fixed sales force, that might be selling. I'm sorry to be a bit stubborn, but this is why I'm just a little bit stuck on, I'm not even sure whether you're trying to get to a fixed number or a variable number. And maybe I'm the slow one in the room and I apologize, but it's just confusing that we have a current requirement for advertising, but we're not being explicit to say whether advertising's in this or not.
David?
I mean, I don't think we're at fixed or variable in any of these. These are just indicators of one direction or the other and questions that go through them. The investors here, we all want to get to like something like fixed, variable, and one time. And this is just an indicator that we have here. And if there is something in selling and costs, and I think Matt had said something earlier, but this is in the, you know, trust but verify category. Like, we have nothing to verify any assertions that management gives us on any of these categories that we've talked about today. And this is not even being able to check the homework on management. All we have is a 20,000 foot directional check to say, that doesn't smell right when it comes out here. Can we challenge this assertion? Can you give us better information? And right now we just don't have any tools to get that. And when I say time will solve that, that's how I think time will solve something like selling. Yours is wildly out of line with the rest of your industry competitors. I don't think that's my job to fix. I think there's other people in the room that could fix that. But I do think time will get there over time. And that's not my primary concern with this. My primary concern is just trying to get fixed variable. Doesn't really fit into that. How I look at it, I'm looking at investment in something that hasn't already happened. And like, what are you dedicating towards? If how much investment are you investing in what I think of as future sales that have not happened yet? But everybody else can have a different view of it. But just to have some question of whatever view it is on this number is where we're trying to get.
Matt?
Yeah, just on that was a great point Mark made about changing definitions. And this is actually, you know, just to beat this horse again, but on a management approach, is that that is a problem with any sort of flexibility, is that we see changes in definitions over time. And, you know, so I've worked on a few companies where they've changed segments, you know, 5 times over 7 years or something. And yeah, at the initial outset, they are reconciled to the, you know, to the presentation, but then the year passes and then you kind of lost it. So it's then a little unclear what's going on. So if there is some sort of mechanism to, or, you know, we definitely support some kind of mechanism to discourage the changing of definitions, perhaps that's requiring, you know, reconciliations, or I don't know if you could outright just, you know, outlaw it, but, you know, just, you know, something there would be helpful. And yeah, on the fixed and variable piece, I agree. Like, I think that there's for selling expenses, the way that I'm thinking about it is that I think it'll be both, right? Because you'll have salaries of some people is fixed, and you'll have some commissions and then partner payments or certain performance advertising versus brand advertising. So it's going to be a mixed bag. So I didn't mean to say that, oh, this is only going to be variable expenses, because I don't think that would be the case.
David?
Yeah, just on the last part of Mark's thing, the change in any of this, that needs to be, yeah, like you said, reconciled, quantified, not just a qualitative disclosure in what changed in your selling definition. It needs to be a quantification. If you change your definition and include something in, I need to know how much that jumped because of that change. Because the important thing about this is trending it over time and making sure it's consistent. And if we throw things in there and out of there qualitatively, we won't be able to track that or verify.
Any final words on selling? Oh, Matt?
So to be provocative, selling minus advertising equals what? They're both be disclosed. I'm not sure. I'm still just lost. So I disclose advertising today. I'm going to disclose selling. Maybe that's a broader go-to-market effort, but I just think there needs to be at least some acknowledgement of how it interacts with the current disclosure requirement. That's my point.
Okay, great. We're coming up on time here. So Julie, I'm going to rob you of your scope tee up. Sorry. On the scope topic, if anybody has anything they want to discuss on that question, I think we have a lot of detailed kind of requests for scope outs that we're going to work through. So if there's just any comments on that, I think those are probably better handled offline, but if there's anything here, and then we can just open it up in the last 5 minutes. Is there anything we didn't cover or skipped over as we work through? We can hit those quickly before we wrap up. Joe?
I did want to touch quickly on scope, and that is, and we put this in letter as well, that we think that this should apply to private companies to help facilitate capital markets transactions, and particularly the speed of integration post-combination. If we haven't invested in the systems, we're skeptical that private companies will, and it can be challenging for us to close transactions subject to antitrust when we don't know the deal is going to close, and then we have SEC reporting timelines. So,
thank you. David, did you have another comment? No, okay. Any other final comments or things we haven't covered? Yep. Go ahead, Scott.
Just one comment on implementation too, and I think you would have already heard this already, but as it's currently written right now, and as other preparers have talking about significant changes from an ERP perspective, you have to allow enough time in order to adopt this too, right? So I think that is one thing, especially if it stays as it is right now, that there would have to be enough time in order to implement it.
Yeah, I think that we, interim and effective date and transition were something that we got a lot of feedback on, and we thought we'll take that feedback and let's see where we land on all this and take your feedback on the other items, and we'll come back to those. But certainly we heard the message in terms of the time and the level of effort needed to implement, and we'll be mindful of that when we bring it back to the board. David?
Sorry, the other one. We would love this to happen to private companies. We are a little bit realistic on that. But for maybe some of the low-hanging fruit that comes out of this that didn't really create a lot of discussion, maybe think about putting that to private companies. That is a lot easier to pull from a standard ERP system or things like that that aren't on the inputs, because we spend a shocking amount of time just understanding depreciation and amortization, and EBITDA is very important on the investor side, and especially in interim reporting and things like that, and just setting this kind of expectation for private companies to actually put it out there and be explicit about it, and be explicit that this is where it all is. It's not just the portion that they separated out. And because we get lots of differences between DNA on the cash flow and DNA on the income statement, and we often are just taking an estimation path to get there.
Before I move to wrapping up, just want to check in with the board members if there's any final questions or comments. Didn't want to shortchange anybody. Okay, great. Well, I'd like to thank everyone who participated today. I think we had a really lively discussion. I think you've given a lot of things for us to think about. Our team plans to analyze all the feedback we received through the comment letters, what we've received today. We probably will be in touch with many of you on follow-up as we work through the details and we work through alternatives and get ready to come back to the board, hopefully in early 2024. So be on the lookout for our action alert when we announce that meeting. And I encourage you to subscribe to our action alerts if you don't already. If there were topics that you were interested in getting into details that you didn't get to a chance to discuss today, we're always happy to set up calls and discuss in more detail. And we really appreciate the engagement and the feedback. You know, as we talked about, a lot of this is in the details, and we want to understand what's going to be useful, what's actually practical from the systems, what's going to be auditable. And we really just need all of that input from you all to come up with things that are practical to bring back to the board. So with that, thank you. And I hope everyone has safe travels today and a happy holiday and a happy new year. So thank you.